the data center and AI build out is going to be extremely expensive. That's starting to weigh on the market a little bit.
There is an expectation that we'll start to see a leveling out in Mag 7 earnings growth rates.
I still think there's probably some room to see more pullback.
New leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
6-12 months ago, the fundamentals looked better. We're more on bubble watch than bubble call.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. The weight of the global equity market on Nvidia's shoulders as Target is preparing to shine a light on a very gloomy US consumer. President Trump is inching even closer to naming the next Fed chair. That decision just weeks away.
Yeah, speaking to our own Annmarie Hordern, who is still down in Washington, D.C., President Trump saying, I think I know my choice. I'd love to get that guy currently in there out right now, but people are holding me back. He also talked about how occasionally it's good to be politically correct. So you have to wonder, is this sort of putting some wind in the sails of Chris Waller, or is there somebody else who he thinks is the more politically correct choice?
I had the same question. Who is the politically correct choice in the mind of the president? In the mind of the market, it's Governor Waller. He's already at the Federal Reserve. Let's go. Standard call. Someone sitting at the Fed, ready to cut rates. He's my guy. In the minds of the president, what's a politically correct choice?
Right now, according to Polymarket, Kevin Hassett is the favorite with a 46% chance, and Chris Waller has a 19% chance. So I think that there might be some delta between the politically correct choice of President Trump and the politically correct choice of markets. However, Scott Bessent is very attenuated to what the markets care about. So how much is he going to maybe move the needle here?
We'll catch up with Annmarie in about 10 minutes on this story in just a moment. Need to talk about Nvidia as well. Nvidia in the pre-market, just about positive. Nvidia's had a really tough go of it over the last month or so. Down about 12% or so from the October high. Some high-profile exits as well. SoftBank sold its stake. Peter Thiel's hedge fund sold its stake. This stock's under pressure in a way it hasn't been in a long time.
The central bank of Nvidia's decision comes after the bell today, and I have to say that the entire market is riding on it. To me, the idea, you pointed to that 12% drawdown, that includes $630 billion of market capitalization evaporating from the global tech sphere. And this raises a question about how much they're able to underpin the global rally and optimism around growth. Ultimately, one person was saying that this is a so goes Nvidia, so goes the market kind of report. It does feel like they have a very high bar to cross, and it raises a question going forward about whether the people who've just recently got out of Nvidia were just getting out to get into something even more ambitious, or whether they're getting out because getting out is pretty good.
We've heard from their biggest clients, the hyperscalers. Their spending intentions are up, not down. There should be a good story to tell here. But the way the market treats these earnings has shifted. And shifted markedly. The way this market has treated this story has shifted markedly as well. If you think about the last 24 hours, we had a deal, another announcement. This time, I think it was Nvidia, Microsoft, Anthropic. Have a look at how those two stocks performed yesterday. Microsoft down 2.7%, Nvidia down by 2.8%. Do you remember not so long ago when you see a deal like that, the stock was up 10, 15, 20%? That's not happening anymore. Things have changed.
Yeah, people have gotten the joke. They understand they're all in bed together. So are they in bed going to a good place, or are they in bed going downhill? And this is sort of the question when you have Anthropic getting a cash infusion from both Microsoft and Nvidia for power centers that'll be powered with Nvidia chips and with the Azure cloud computing system of Microsoft. It raises a question. If one weak link goes down, how much is the entire ecosystem threatened? That increasingly has come to people's minds. Add tens upon tens of billions of dollars of debt upon it, well, and you have yourself a minor correction.
It's the main event later on this afternoon. Nvidia in the pre-market up by 0.75%. An exclusive conversation with Jensen Wong and Ed Ludlow on Bloomberg TV later on this evening, so look out for that. Coming up this hour, we'll catch up with Julian Emanuel of Evercore with stocks on their longest slide since August. The former U.S. intelligence official Norman Roule as the U.S. and Saudi Arabia deepen ties, and the Nokia CEO Justin Hotard on the company's push to create the first 6G network. We begin this hour with stocks edging higher as investors count down to earnings from Nvidia. Joining us now to discuss is Bloomberg's Mandeep Singh. Mandeep, good morning. Look, the stock story's not great. Surely the earnings story is going to be okay.
Look, I mean, the best way to frame it is, you were discussing about hyperscaler CapEx. We know at the start of the year, the expectation was that CapEx would grow 20% in 2026. Now it's close to 40%. So from that perspective, NVIDIA numbers should be revised upwards. And, everyone has talked about building more gigawatts when it comes to AI data center capacity, whether it's OpenAI or any of these hyperscalers. And the question that investors will ask is, how much is NVIDIA's share in that gigawatt build out? Because that's how they're going to generate, more revenue is if OpenAI builds 30 gigawatts and they have to rely on NVIDIA's chips, then there is no choice but to pay NVIDIA, the higher gross margins that they have commanded so far. Whereas Google told us yesterday that Gemini 3 was trained entirely on TPUs. So from that perspective, they're not going to get their cut in terms of what Google is building around AI data centers. So that's the key question for me is, how much NVIDIA manages to keep their share going forward in this gigawatt build-out.
Mandeep Singh of Bloomberg Intelligence on NVIDIA. Those numbers dropping later on this afternoon. Here's the view on Wall Street so far this morning. Julian Emanuel of Evercore calling for the S&P to hit 7750 by the end of next year, writing the path to a bullish long term is often a series of volatile, uncomfortable short terms. This is one of those times. Julian joins us now for more. Julian, good morning.
Good morning.
Things have changed. Why have they changed? What's behind this recent shift, the way the market treats this story?
It's actually the debt concerns, in our view. Again, because, and this is inescapable, and we talked about this a number of times throughout the year, you cannot get away from the comparisons to the late 1990s in many respects. And when you think about the late 1990s, the problem with the bursting of the bubble, besides the fact that the Fed was hiking in 1999, was the fact that a lot of the build-out was financed by companies that were incurring debt and had no revenues on the other side. And because you've seen this accelerating debt issuance, there is the worry that that is coming back. And we would say that's actually a good, rational worry.
Well, and it's a worry potentially to buy. I mean, I guess that this goes to the question of what makes you so bullish on an ongoing basis, despite some of the rhyming features of this particular rally with respect to the debt component?
Well, so a number of things. Again, the macro backdrop is favorable, okay? The Fed is going to be cutting. We're going to have more stimulus, whether we get $2,000 in our pockets at some point next year or not. We're going to have more stimulus. And from a valuation perspective, as much as angst as there is, in fact, certainly in comparison to the late 1990s, these names are, I wouldn't say cheap, but they're certainly not expensive relative to history, and they're not expensive relative to their own history. And what we've seen over the last several years in a lot of them is they just mark time going sideways, so earnings catch up to valuation. And that's an ongoing process.
At the start of the sell-off, at the start of November, it was very much what you're talking about, a realization of the debt component. It seems like the tone has shifted over the past couple of trading sessions to not just a tech story, but to an everything story, raising questions first about whether the Fed is going to cut next month, and second, whether the U.S. economy is strong enough to withstand some of the optimism without that rate cut. How much do you see that story continuing? The idea that maybe the weakness under the hood is part of what's pushing this story as much as the debt overlay to artificial intelligence?
Well, a lot of it is the fact that we simply haven't gotten data for the last month and a half. And, in the beginning of it, it was okay, fine, the markets were doing well. The uncertainty is a positive, but then investors realize that uncertainty is uncertainty and should be discounted. Our suspicion is that over the next number of weeks, as we get back to normalizing the data releases, people will at least have something to anchor on. And the question is, in terms of the economy, and which is certainly the question that's the backdrop for sustaining these valuations and, of course, monetary policy, is the economy okay with the slower speed of job growth? We think the sort of the monthly break even is somewhere between 30 and 60,000 jobs. Is that palatable? We think the answer ultimately will be yes.
Julian, forgive me, it's almost like we've forgotten what it was like when we had the data. When we had the data, people questioned it all the time. They questioned the quality of it. They didn't like the payrolls data. In fact, the payrolls data was super weak, even if you believed in it. And I don't know how relevant the equity market story was to the payrolls data we've seen over the last 7-8 months anyway.
Well, we have never put stock in the monthly payrolls data. it's the weekly jobless claims data that's always been high frequency importance, and we've been sort of calculating it back of the envelope at Evercore ISI these
Anything
last
to worry
number
about?
of weeks. No. It's, steady as she goes, 230,000 every single week. And I think once that becomes transparent, we're going to see that again.
Does it come down to this? The stock market, what it really wants, the earnings story that it's already got, but it wants the rate cuts too. And to get the rate cuts, you need the weak jobs data. Is that what it comes down to?
Look, at 26 times, you have to have constant positive narrative. Stocks are expensive. Stocks being expensive is not a reason to sell the market. It can be a headwind, as it is at the current time when you have this uncertainty. But again, ultimately, to your point, John, is that earnings revisions are just phenomenally strong. The runway to next year in terms of earnings growth is great. And as I look at it, our 77.50 price target is likely not going to imply any multiple expansion, which makes me want to mop my brow in relief.
Well, mop your brow in relief or put a higher multiple on the idea of bubble territory. We're on bubble watch, or maybe bubble call, or whatever you want to use the word, B word, that everyone seems to be overusing these days. What would it take in terms of Fed rate cuts to get to your extreme bubble call, full bubble, which you put at a 30% chance currently for next year?
You'd probably need 4 or 5 cuts in an economy. Well, look, back it up. The fact is that in the last several weeks, both the trajectory for growth and the trajectory for inflation appear to be improving. We took our number down to 2.7 on core PCE for the end of next year. That's certainly going to be sufficient enough for the Fed to cut. We took our growth number up to 1.9. And frankly, the way the setup is right now, there could be upside to the growth number and downside to the inflation number.
Julian, it's good to see you. An optimistic take on the future. Julian, Emanuel of Evercore, following a 4-day slide on the S&P 500. Futures near session highs up 1/3% later on this afternoon. Earnings from Nvidia later on this morning. Numbers from Target. Look out for those numbers around 6:30 Eastern time. Let's keep an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. After Home Depot stumbled yesterday, we are seeing shares of Lowe's rising more than 5% after topping earnings estimates for the third quarter, while net sales grew 3% year on year. Lowe's also raising its full year sales guidance as the company is updating its outlook for operating results to reflect ongoing uncertainty in the current macroeconomic environment. Meanwhile, President Donald Trump says he thinks he's identified his choice to be the next chair of the Federal Reserve. Treasury Secretary Scott Bessent narrowed the pool of contenders to current Fed governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, White House National Economic Council Director Kevin Hassett, and BlackRock's Rick Rieder. And in Europe, UK inflation fell for the first time in 7 months. The drop was driven by energy prices rising by less than they did a year ago. The data keeping alive hopes the BOE will cut rates at its next meeting. Traders are pricing in an 80% chance of a cut next month. That's your Bloomberg brief. John.
That decision on December 18th. Some good news for the UK for once. Yahara, thank you. Up next on the program, choosing the next Fed chair.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
I think I already know my choice. It's nice to every once in a while go politically correct. But we have some great names.
Annmarie joins us next from Washington, D.C., live from New York City this morning. Good morning. Four-day slide on the S&P 500, the longest losing streak going back to August this morning. A bounce, up by 0.4% on the S&P. On the Nasdaq 100, up by 0.5%. Later on this morning, about 14 minutes away, we get numbers from Target. The numbers yesterday from Home Depot, not great. Numbers from Lowe's just moments ago.
Yeah, and the numbers from Lowe's had kind of a mixed feel. On one hand, their comp sales for the third quarter were below expectations, but full year forecasts came in above expectations, which really gave people positivity. Also, they have a new partnership with a company that works with professional contractors, which seems to be bolstering some of their views as well. They did talk about the hurricane season, but still, they're talking about total sales for the full year of $86 billion. That is above where they had previously seen. Going forward, in general, a much more optimistic tone than what we saw over at Home Depot.
They've got a better story to tell this morning, that's for sure, because Home Depot did not. We'll target. This is the issue. It's a market that's looking for a re-acceleration, a pickup in economic growth into year end and out the other side. Is that what we're hearing from these companies?
Yeah, is it going to be a same story from Target that the consumer is kind of muddling through? Or is this going to be the same kind of story as what we saw from Home Depot and Lowe's? There's a winner and there's a loser. And there's a question of market share consolidation. Is this a question of Home Depot facing a very difficult macroeconomic backdrop? Or is this maybe losing share to Lowe's or potentially the Lowe's team doing a better job in managing efficiencies? Are you going to see the same kind of nuance with, say, Target versus Walmart? That's one of the key questions.
Target at 6:30 Eastern Time. Walmart numbers coming up tomorrow. Under surveillance this morning, let's talk about the central bank choosing the next Fed chair.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
I think I already know my choice. We have some surprising names and we have some standard names that everybody's talking about. And we may go the standard way. You know, it's nice to every once in a while go politically correct. But we have some great names.
So here's the latest this morning. The White House nearing its final round of interviews for the next Fed chair, saying we might have a pick by Christmas. Annmarie asking her questions in the Oval yesterday joins us now from Washington for more. Annmarie, it feels like we're getting closer.
It does feel like we're getting closer, Jonathan. And we should say, the president immediately said to me when I asked that question, yes, he started the interviews and he already knows in his mind who he has. And then his glance and his eyesight went right to his Treasury Secretary, who was sitting there on the couch to his left, and said, you know, I'd like him, but he's happy at Treasury. And then Scott Bessent once again said, yes, I'm not leaving my post. And then Bessent clarified that interviews will start to begin in earnest and that they should be wrapping this up before the end of the year. It was also interesting. The Treasury Secretary was asked about this last night on Fox News, and he said, I will not be the Fed chair. And then he sort of turned it around with the president playing coy with him all the time and said, you know, I think President Donald J. Trump would make a great Fed chair.
Isn't it super on brand, Bramo? The Crown Prince Mohammed bin Salman is in the room alongside the President of the United States. What do we ask? Questions about the Federal Reserve.
I was thinking the same thing. Thank you for representing us well, Annmarie. We really appreciate it. Keep up the good work.
AMH, what was the big takeaway on the big Saudi meeting?
Well, also just to clarify, before I got to the Fed, I did ask about the agreements going on between Riyadh and Washington, D.C., and I also asked the Crown Prince. One of the big takeaways from that Oval Office meeting for the business community is that he wants to expand not $600 billion, but $1 trillion in investment. And how do you do that when oil prices continue to stay in a range of $60 a barrel? And for more on that, we're joined by former senior U.S. intelligence official Norman Roule right here in the studio. Norman, thank you so much for joining us this morning.
My pleasure. Good morning.
You have serious detail in regards to the relationship between these two countries. I would love to get your answer because the Crown Prince, His Royal Highness, actually ignored me when I asked that. He wouldn't give me a price. But can Saudi Arabia maintain this level of investment where oil prices are now?
I believe they can, but I think it's a question of how long it will take them to execute this investment. And that answer will be over years. They did not indicate yesterday how many years it will be before these agreements are completely fulfilled. And I think we're probably looking at a decade or more. And that really strikes to the heart of what this meeting was all about. This was a transformational agreement between the two countries where the Saudis and the Americans are investing in each other's futures in energy, artificial intelligence, minerals, chemicals, and defense. And this will take a decades for this to play out. It's a really transformational agreement.
It will take years because also looking at the fact sheet, they use a lot of words like commitments, memorandum of understanding. A lot of what we heard yesterday, we heard during President Trump's trip to the Middle East in May. If you're sitting in Saudi Arabia, though, and you want to make investments, is it challenging to do that with the United States that runs on a 4-year election cycle?
It can be, but I think we've seen a lot of progress that has not yet made it to the press. Over the last 5 or 6 months, there has been an intensive exchange of officials between the two countries. Diplomats have been working furiously to flesh out the paperwork. The F-35 announcement is not something that occurred yesterday. for example, and I know the same thing has happened on nuclear issues, on energy matters, and on broad defensive military industrialization issues for Saudi Arabia. So I think we should look for the next 3 to 6 months for rollouts of American companies engaging their counterparts on these issues. It's going to be a very busy season for U.S. and Saudi engagement.
You mentioned the F-35s. There's also this defense pact. The president yesterday talked about Saudi Arabia becoming a major non-NATO ally. What does this mean for the Israelis and the path to normalization between these two countries?
Well, being a major non-NATO U.S. ally does not bring a defensive component. It doesn't mean we come to a country's aid necessarily in time of conflict, although truth in lending, I think it's clear that if Saudi Arabia were ever attacked, the U.S. would be there for that country. What this does, it allows Saudi Arabia expedited access to equipment, increased intelligence sharing, some participation in research and development. A number of countries in the region have this relationship already, and it's long overdue for Saudi Arabia in my case. I think the Israelis are going to be uncomfortable with this, but it's a new regional security architecture, and I think the region will have to adjust to that architecture itself.
In the Oval Office yesterday, the president made clear he had this conversation about normalizing relations between Riyadh and Jerusalem. Do you think that gets done in Trump's term?
I think it's possible, but it's going to be difficult. The issue remains Saudi Arabia has made it very clear they will normalize relations with Israel when there is an irreversible path to a two-state solution between Israel and the Palestinian people. That appears very unlikely at present. And the Crown Prince was very clear. He wants to join the Abraham Accords when that happens. That does not appear likely now. And for that to happen, we would not only need to see significant political changes within Israel, but serious transformation among the Palestinian leadership itself, which appears a long way off at present.
I want to end on Iran. The Crown Prince reportedly got this letter from the Iranian President Masoud Pezeshkian before he went to the United States. What do you think was in that letter? Could Saudi Arabia be at the table to potentially facilitate talks between the United States and Iran?
The Crown Prince was clear. He would do what is necessary to assist in discussions. Right now, my sense is that the Iranians wish to have engagement with the United States, but the president, I think, is wise in not seeking engagement just to have engagement. You see, if you're Iran and you have engagement, that automatically raises your rial, supports the economy, it helps the government, but it doesn't actually produce a nuclear agreement. My sense is the Trump administration will seek engagement when they believe the Iranians are serious about talks, and they don't believe the Iranians are serious at present. And the Trump administration has many other fish to fry.
Norm, thank you so much for your time this morning.
My pleasure.
That was, of course, Norman Roule, a former U.S. senior intelligence official. My big takeaway sitting here, Jonathan, in Washington with Norm is that when you look at the fact sheet, it's a lot of commitments, MOUs. Norm is spot on. This is going to be years and a decade in the making.
AMH, with the latest in Washington, Annmarie, my takeaway this morning is the crude price is exactly where this president wants it to be. Low 60s right now, down about 16% year to date.
How much is that part of the tacit agreement behind the scenes? Because there's a question around what the U.S. got in return for some of the pledges to provide chips, et cetera. If you want an answer to that, some people have suggested, not me, but some people have suggested take a look at the oil price and how much it has remained within this 50 to 70 band. And that really is where it's going to remain regardless of the geopolitics, which really puts a lid on the potential inflation coming from energy costs.
I'm not sure how happy the shell patch is with these numbers, but that's a different question altogether. Crude this morning down about 1%, $60 and about 13 cents. Up next on the programme, we'll turn to the retailers in America and the US consumer. Sucharita Kadali of Forrester with target earnings just around the corner. Plus, Danny has your morning movers. Lowe's rising on better than expected numbers. That stock is up by 4%. Live from New York City, you're watching Bloomberg TV. Live from New York City this morning. Good morning. Let's take a beat. 4-day slide on the S&P 500. 4 days of losses amounting to almost a 4% decline from all-time highs in the last month or so. We bounced back this morning, up by 0.38% on the S&P, on the Nasdaq 100 up by 0.46%, on the Russell, the small caps up by 0.56%. So a bounce so far this morning. Let's see if this sticks. In the bond market, not much offset coming from the long end of the curve. A bit of a debate on what this might mean for the Federal Reserve on the 2-year, 357, but Lisa still firmly in that range between 350 and 360 at the front end of the curve.
You've seen a fluctuation over the past week in terms of the Fed speak buffeting around next month's Fed rate cut expectations. And the long end, I wonder how much is the story I pointed to yesterday about what's going on over at the Bank of Japan and the idea that long ends are rising there and how much that's kicking around the long end of the yield curve around the world. I also wonder how much some of the long-dated issuance from some of the tech giants also is creating perhaps a supply and indigestion issue for that particular denomination. Nonetheless, to me, the real question is, what's driving the sell-off? Is it the Fed or is it tech fears? I mean, last night at the dinner table, people asked, they were like, what's causing this?
What did you say? We all want to know. Describe the Bramo household dinner.
I just, took a bite. I was like, I'm sorry, I'm busy. No, I said, look, ultimately people don't know. There could be just sort of this concern about the debt. I'm sure all the kids' eyes glazed over.
Sure.
Then I said it could be about the Fed.
Because they've heard that one before.
And their eyes glazed over. And then they said, please pass the Brussels sprouts.
Does this week have the potential to sort of reopen the door back towards that melt up into year end, that Santa rally? Two things have the potential to do that. The jobs report could unlock that Fed debate for December 10th, and Nvidia after the closing bell could unlock some of those fears about the AI trade, maybe just calm things down just a touch.
Yeah, how much do they have to beat to get people really excited again? Or have we already seen the sort of pre-release sell-off that sometimes happens post-release, right? We've already had that 12% decline in Nvidia shares. Is that setting up for just a wave of positivity when they come out and they say, actually, we do own the world? Just pay us your money.
I mentioned this a little bit earlier. Don't miss the conversation with Jensen Wong, the Nvidia CEO, sitting down with Bloomberg's Ed Ludlow later on this evening. As we count you down to the opening bell, 3 hours to go. Let's get you some single names, some morning movers. Here's Danny with more. Hey, Danny.
Hey, John, some more retailer earnings to work through. We're getting Target now, but also Lowe's in the past half hour. Shares are up 3.7% because they did have a better third quarter than expected, but maybe some of this is about expectation setting. Shares sold off yesterday with Home Depot. They're down 11% year to date. Not to mention, for the full year, they did narrow their outlook below the high end, saying that the macroeconomic environment was weighing on them, and they also see a flat year for 2026. Elsewhere, Constellation Energy, those shares also higher by 3.2%, getting a $1 billion boost from the Department of Energy. The government giving them a $1 billion loan to help them reopen 3 Mile Island. Chris Wright, the energy head in the U.S., saying that this is helping lower the cost of energy. Again, it's that focus from the administration on the cost of living. Finally, rounding things up with some sell-side action, DoorDash gets an upgrade from Jefferies, saying that they basically have lowered the bar. They had a record sell-off earlier this month after their earnings with the new investments, but Jefferies says that after that sell-off, and not to mention that growth is looking good at DoorDash, they are recommending a buy on that stock, John.
Danny, thank you. That stock is up by 3% at the pre-market. Talking about affordability in this country. Trying to order food now through anything like DoorDash, any of those kind of companies in, say, a city like New York, has become so expensive, ridiculously expensive, I think prohibitively expensive to order food through these destinations now.
It's actually spurring me to use my legs much more.
Right, get up and go and pick it up.
Actually, go get it, because ultimately you're looking at a service fee, then you're looking at a potential processing fee, then you're looking at the driver tip, then you're adding to the restaurant manufacturing fee. Whatever. The fees just start adding up in addition to the prices of the actual meals, which are going up as well. Yeah, you're right. But people are clearly still going.
Rebuild that relationship with these restaurants and the customer. There is a restaurant that I order from every Friday evening, almost every single week. And I bet they don't even have a clue who we are because we go through the order and the delivery company, right? The way it used to be is they knew who you were. They threw in some dessert. They gave you an extra piece of whatever you liked. And now no one knows who anybody is anymore because there's this weird intermediary that's charging you all this money to connect you to the restaurant that you go to every single week without the restaurant even knowing.
Yeah, there's not that relationship really with the restaurant and not really the recourse. make ordering food great again.
Right, there you go. Okay, we've got some news to talk about. On our radar this morning, investors counting down to Nvidia earnings due after the closing bell. Traders eager to see if the billions spent on AI are paying off. Analysts expecting the company to show 50% growth in both net income and in revenue. Elsewhere, the Apollo CEO, Mark Rowan, downplaying recent concerns over private credit. Rowan was speaking at Bloomberg's New Economy Forum in Singapore.
Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
Rowan going on to suggest it's probably rational to reduce risk in the current market environment. If there's a guy out there that I'd pick up the phone to just to calm me down, it would be that guy right there. Mark Rowan, always prepared just to talk you off the edge of the cliff.
Well, and frankly, he's got a lot of stake in the game. He's got a lot of skin in the game with respect to just how big their investment is in private credit. Of course, Apollo is focused more on the investment grade side of things. They're not focused as much on the speculative range of the credit. We've heard this from so many of the private credit investors. We've also heard from the big bank CEOs. Yesterday, we heard from John Waldron of Goldman Sachs, and he was saying, yeah, there could be a little bit more to go. It wasn't exactly ringing the red flag or ringing the five-alarm fire. There was a question here just about a blow off top that seemed healthy. It seems like there's a contradiction between cockroaches that are going to unmoor the whole system and potentially valuations that got a little heady that are now getting a little bit lower. And it seems like more and more people are leaning toward the latter.
Given what's emerging there, can a 25 basis point reduction of the Federal Reserve make a difference? Who's going to lead the Fed in 2026? Annmarie had a little exchange with the president yesterday. The president indicating he knows his pick to be the next Fed chair. The president mentioning he may opt for a contender that's seen as, quote, politically correct, with the Treasury Secretary Scott Bessent saying he'll hopefully have an answer by Christmas. The Treasury Secretary hoping the answer isn't him.
Yeah, well, he is saying it is not going to be him. Most people tend to agree. Question is, and we were talking about this earlier, who's a politically correct choice for the Federal Reserve? Is it politically in the eyes of the market? Is this politically in the eyes of President Trump? Because ultimately, right now, people think it's Kevin Hassett. The market thinks the politically correct version is either Chris Waller or Rick Rieder. The other potential contenders are Kevin Warsh, who seems to have fallen off the map with respect to anyone ever mentioning him, or Michelle Bowman, who's making her own waves as the vice chair of supervision and kind of what she's doing with respect to some of the oversight of banks. So a real question here. It ultimately seems between Rick Rieder, Kevin Hassett, Scott Bessent can't get his name out of it, and of course, Chris Waller.
Keeps coming up, doesn't it? The president says, I've made my pick. And then he looks at the Treasury Secretary and said, I wanted him. So is that still your pick? Or is it someone else?
It seems like it's someone else because he gave him an out and Scott Bessent was saying absolutely not. So it seems like that's not going to be the case. Nonetheless, there still is a chance, at least on Polymarket, that is the end pick for the Fed.
I said this story had gone quiet yesterday. Annmarie bringing some life back to that story down in Washington, D.C. in the Oval. We did get some earnings from Target, so let's talk about those numbers. They crossed moments ago. They see the full-year adjusted EPS outlook at about $7 to $8. They had seen $7 to $9. So just bringing down the top end of that range for the outlook from Target. The stock, Lisa, down by 2.3%.
Yeah, this isn't as good as a lot of people expected. Full-year adjusted earnings per share now between that 7 and 8 versus the 7 to 9. But also looking at third quarter comp sales, down 2.7%. The estimate had been 2.06%. Overall, pretty much a miss across the board. Net sales, net EPS gained a little bit. Then this headline drops. OpenAI and Target report a partnership. Target will continue relying on ChatGPT Enterprise, according to OpenAI. Not even a mention of OpenAI or artificial intelligence could help boost these shares in futures markets. I mean, I don't know what to make of this, but clearly this is going to be the tenure of the tone of a lot of different corporate earnings. How are they deploying artificial intelligence, and how will it actually improve their bottom line?
We often say on this program, you can learn something from the numbers and learn something from how the market responds to them. The way the market responds to this story has changed. There wasn't so long ago, maybe weeks, not even months, when you saw a story like that, the stock would be up 5-10%. Likewise yesterday, with Anthropic, Microsoft, Nvidia coming out and doing the usual, we'll get together, I'll spend here, you'll spend there, we all do better, hurrah. And you'd see a 5-10% move in all those stocks. We didn't see that yesterday either. Things have changed. Things have shifted. How permanently so? I've got absolutely no idea. It's an observation. But without a doubt, things have changed.
Investors want to see the money. They want to see the results. They want to see the use cases. They aren't happy enough with someday it will make an incredible difference. Right now, Target is coming out saying the COO is talking about we are relentless in our pursuit of returning to growth and not satisfied with our current results, talking about gaining more efficiencies with respect to their partnership with OpenAI and using ChatGPT in their systems. How can they do this? How effective will that be? Will this come from job cuts? This isn't the hopes and dreams pie in the sky that it will massively expand the business model of so many different companies. And I think that reality check is what's really got people's psyches in the market.
To make it super simple, do we have a Target problem or a consumer problem? Check out Walmart off the back of these numbers. Walmart down by 0.7%. Walmart reports tomorrow. There's a bigger and bigger worry that the more you hear from these companies who are struggling to generate growth, it's not just a company-specific issue. It might be a broader issue.
Especially if Walmart performs well. There is a question of how much they're able to do this in the back of efficiencies, on the back of just cutting costs through rapid deployment of technology. Is that a good story for the consumer, or is that potentially a negative read on the consumer in terms of the levers that people are pulling in order to have good results? It's not good enough just to have okay results. It's also the why. Where's the growth strategy? It might be good for Walmart's shares, but it might not speak to a consumer. Right now, what we heard from Target is that there was choppiness across their business. They've been trying to figure out what exactly it is. But again, that consumer discretion seems to not necessarily be driving results in the same kind of way.
Home Depot yesterday, look, they've turned around and told us mortgage rates have eased. We got what we wanted there, and it didn't result in a pickup in activity. What else do you need to know? The interest rate reductions, the looser financial conditions, the lower mortgage rates have not resulted in a pickup in economic activity, which is why the Governor Wallers of this world are still making a case we need to go even lower on interest rates.
Yeah, of course, Lowe's performed better. Lowe's had a better outlook. How much is this a strategy issue? How much is this a broad consumer issue? And how much is this a softness in things like the housing market or, frankly, the hurricane season, which, again, Lowe's also made mention of? I think Walmart's going to be the real key in all of this. If Walmart reports that the consumers are going gangbuster and are doing great and are going out there, well, Target will lose even more and Walmart shares will do well. And it will speak to the muddling along kind of economy that so many people point to. It is a mystery wrapped in an enigma.
And we're going to unwrap that enigma with a mystery buried in it tomorrow morning, aren't we? Payrolls at 8:30 Eastern Time, Walmart as well. There's a real chance that you get some greater clarity tomorrow, at least I hope we do, on the American consumer and the path forward for this Federal Reserve. Numbers from Target out just moments ago. The stock is down by about 1.4%. The company just trimming the top end of its outlook as it looks forward and sees pretty flat growth at the moment, and that is a problem. That stock is down in the pre-market. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Just to recap those earnings, we are seeing Target shares down 1.5% in the pre-market after posting mixed results for the third quarter. The retail giant beat earnings estimates but saw revenue come in lower than expected. Target also narrowing its adjusted EPS guidance for the full year. Along with the results, Target announced a partnership with OpenAI. Meanwhile, Meta defeating the government's antitrust case over its acquisitions of Instagram and WhatsApp. A district judge ruling the FTC failed to prove Meta still holds monopoly power, saying rivals like TikTok and YouTube are competing for user attention. And Elon Musk returning to the White House last night to attend a high-profile gala dinner honoring Saudi Crown Prince Mohammed bin Salman. Musk's appearance could be a sign that tensions between President Trump and the world's richest man have eased. Other guests included Tim Cook, David Allison, Jensen Wong, Lisa Su, and football star Cristiano Ronaldo. That's your Bloomberg Brief, John.
Very cool. Yahira, thank you. More from Yahira in the next hour. Up next on the program, betting big on AI.
Nokia is in all of the world's base stations. So we now have this fabric that we can deploy AI computing services on top of it. It's going to be completely revolutionary.
We'll talk about that revolution in just a moment with the Nokia CEO from New York City. You're watching Bloomberg TV. 4-day slide on the S&P 500. On the S&P 500 so far this morning, we're doing okay. Going into the opening bell a few hours away. Plus, Nvidia after the closing bell very much in focus. Stocks up across the board here, up by 0.4 on the S&P. On the Nasdaq 100, higher by 0.5. One single name to talk about this morning ahead of earnings from Walmart tomorrow morning. Target out just moments ago. Target down in the pre-market, softer by 0.8%, just cutting the top end of its outlook. The outlook not great. Growth's pretty flat, and we're trying to figure out if this is a Target problem or a broader consumer issue in this country.
And ultimately, Walmart might hold the keys to that. It seems like Target is looking at greater efficiencies, that they're not happy with performance. Target has struggled with inventory issues and a host of other lack of competitive power with respect to Walmart. I just wonder how much the OpenAI announcement really played into that question, saying that they're going to use ChatGPT's networks to try to make themselves more efficient going forward.
Target down by 0.9%. Under surveillance this morning, betting big on AI.
Nokia is in all of the world's base stations. We're going to be able to provide AI services, which is going to be able to make it easier for us to do robotics and autonomous vehicles and industrial automation and reach all of the different places around the world. So we now have this fabric that we can deploy AI computing services on top of. It's going to be completely revolutionary.
So here's the latest this morning. Nokia announcing a new plan to streamline its business with a focus on AI. The Nokia CEO, Justin Hotard, saying Nokia changed the world once by connecting people and will again by connecting intelligence. Justin Hotard joins us now for more. Justin, good morning. Good to see you.
Great to see you, John.
We've got some time with you, so let's take a big step back. Our generation, of course, knows your company well. Late 90s, early 2000s, handsets. What do you want it to be in the next few years?
Yeah, I want us to be a company that's known for connecting intelligence and ushering in the AI era. And here's why. If you think about that time where the world came to know Nokia, it was about connecting people. That, of course, was the tagline. But it was mobile devices. It was text messaging on a 12-key keypad. It was calling people anytime, anywhere, calling our friends, our family, our work colleagues. And of course, it was about the game Snakes, which I got more messages from when I was announced as CEO.
Absolutely hooked on it.
So, but then the world changed, and the internet super cycle came, and it was all about connecting information. And as mobile devices became not just about calling, they came about applications and data. Nokia lost out and moved from being a handset provider to being a network provider, an infrastructure provider. And the reality is, if you look at the telecommunications industry, our primary customer base, the industry also was slow to capture that transition. Really, if you think about 2G and 3G mobile communications, they were largely about voice. Mobile data was coming in, and we were building better voice networks. So as bandwidth went from mobile apps to mobile streaming, the industry's been catching up. 5G still fairly low penetration when you think about it globally, 35% penetration in the market. So as we look ahead, we need to start anticipating where the market's going. And with AI, the market is going to change dramatically. It's already changing in the data center, which is a part of our business. We're building AI factories. Obviously, Jensen talks a lot about this. I know NVIDIA has earnings later today. But we're connecting data centers to each other and building massive AI factories. That's using our optical technology. It's using our IP routing technology. And where's the future headed? The future's headed to physical AI, robotics, autonomous vehicles, delivery drones, AR, VR, glasses, more and more devices. And fundamentally, that means our networks need to change to handle that. And that's what we're planning for and anticipating to seize that opportunity.
Can you briefly describe the growth opportunity here and how the growth profile of your company will change as you make this shift?
Yeah, look, today you see the pockets of growth that we have in the fixed infrastructure. And as we see this build for AI native networks going into mobile, we're going to see tremendous growth there. It's just not coming in the next few years. We believe it will come over the longer term as the market invests and builds, but it's not going to be in the next couple of years. So really think of our business in a couple of ways. Capturing growth in fixed infrastructure today, and then in mobile infrastructure, positioning the business for technology innovation and longer term growth as that market picks up.
What industries do you expect to be most dominant in? Are there particular industries that you think will be fastest to adopt the AI connectivity that you're hoping to provide?
Yeah, I think there's a few things. First of all, there's no question that the core tech industry that we're in today is the engine of growth, right? AI and cloud customers, hyperscalers, cloud providers. And that's, of course, serving the technologies we have today, LLMs, AI agents. But when we look ahead, I see it being in areas like transport and logistics and manufacturing, physical AI, also an area that we already serve that we call mission critical enterprises. Think of public safety, rail, transport. These are places where AI can add better reliability, better security, better outcomes for people. If you think about public safety, for example, emergency services, and those are areas where I think we'll see faster AI adoption. But I don't think we can predict the future perfectly. We need to just anticipate what are the use cases and the needs. It may be that delivery drones, other retail applications also accelerate, and those are early users. So for us, it's about building the plumbing and the core capability that we need.
This is a difficulty for markets right now. This idea that there could be a duration mismatch between the amount of money people are putting into some of these technologies and when we'll actually see results. How do you prepare investors for the fact that the investments that you make might not turn a profit in the same kind of way that they're expecting for 2 years, 3 years, 5 years, even 10 years down the line?
Yeah, first of all, I think this is what's great about our company is that we have all of the assets to participate in those different duration profiles. And one of them I didn't talk about yet is actually our technology standards business, which we're now announcing as a part of mobile infrastructure. That's a business that does IP licensing. So that actually has an even longer duration. So we invest today and we see, we'll see a 10 or 20-year horizon on returns on that business. And the reality is in technology, we always invest well ahead of these curves. We're always 3 to 5 years ahead. And the benefit for investors, for us, is that you're getting the benefit of growth today with what we're seeing in AI and cloud, and you're seeing us prepare so that you can participate as the growth comes later in mobile. And ultimately, underneath that is really strong cash flow with our IP licensing business.
Justin, you've seen the pushback in the market. I'd love some take from you, your reflection on what we've seen over the last few weeks. There is a worry about overbuild, overcapacity, and you operate in the physical world. Are you worried about that, and how do you position the company to leverage this potential, this opportunity, without being a big part of a potential bust down the road?
Yeah, I think, John, you said it perfectly. We need to be disciplined, and one of the reasons we announced the strategy that we announced today is around being disciplined. We can't invest in mobile networks assuming that we're going to have growth next year. The reality is the mobile network providers, the telcos, are largely flat. They have challenged returns on their capital. So we have to be disciplined around where we invest, and we have to be incredibly efficient around those investments. The other side, though, is even if you look, there's a lot of excitement and talk about a bubble, but even when you go back and look at the internet bubble, the dot-com bubble was a couple of years, and then growth and infrastructure continued. If you go back and look at the players that won, they were prepared because they were investing through that cycle. And from an R&D perspective, we have to continue to invest through that cycle. And honestly, when I look at some of the fundamentals, when I look at the value that AI delivers, the productivity impact, even the productivity impact we're seeing internally in some of our use cases, and the potential productivity impact for the things we haven't even deployed yet, there's so much ROI. And I think that's what's a little bit different about this, is that from a business and a productivity perspective, it's much richer than what we saw in .com. .com in the early days was largely a consumer phenomenon. This is much more about business productivity. And that's why I think even though we will have periods of digestion, and we may have some players come in and out of the market, all very natural in tech. By the way, we see this in every cycle. I think the long-term trends are very, very favorable. And for us, and certainly as a CEO of a tech company, we need to be looking at the long term. And that's why this partnership that we announced a couple of weeks ago with NVIDIA is so important. And certainly, I think Jensen obviously has clear vision for the long term.
Yeah.
But that's why there's so much synergy between us, because what he's doing and his vision for where this needs to go and our vision for what we need to deliver are just very, very naturally matched.
I'm looking forward to tracking the story with you. Thanks for dropping by.
Great to see you.
Enjoyed the conversation. Justin Hotard there, the Nokia CEO. Up next on the programme, the second hour of Bloomberg Surveillance, we'll be catching up with Libby Cantrill of PIMCO, Francis Donald of RBC, and Ashok Bhatia of Neuberger, Berman. From New York City this morning, good morning.
I think the economy is worse than we realize. There is a chance of recession.
The consumer is under a bit of pressure.
It's about the K-shaped economy.
You're probably likely to see the low-end consumer get a bit better.
At the end of the day, we are seeing still strength in the consumer spending, and that is fueling business on Main Street.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Following a 4-day slide on the S&P 500, your scores look like this. On the S&P, bouncing back just a touch. We're higher by 1/3% on the S&P 500. On the Nasdaq 100, we're up by 0.4. On the Russell, we're up by 0.5. The main event a little bit later after the close. We'll hear from Nvidia. Before we get there, let's head over to Singapore. Bloomberg's annual New Economy Forum is underway. Bloomberg Editor-in-Chief John Micklethwaite is speaking with the Prime Minister. Let's take a listen.
China will feel the same way. And while there may be differences, the two countries can still get along and work together.
The current atmosphere, what do you think the chances are of a war over Taiwan?
We've always said that we don't think this is likely to happen in the foreseeable future, at least in terms of a unilateral, unprovoked action by China. You've asked this question repeatedly to my predecessors, to me.
So far, you've been right.
And our views remain the same. It is an important issue for China, Taiwan. It is the reddest of red lines. But I don't see, and we don't see it happening unless something happens that really crosses China's red lines in terms of, for example, a unilateral move by Taiwan to declare independence, because then it becomes two Chinas, not one China. I think America's policy here also is very critical. And America has always been consistent and very careful with its policy that there should not be any unilateral change to the status quo. And number two, that while America defends or supports Taiwan's ability to defend itself, it does so in accordance to the Taiwan Relations Act and to America's One China policy. It's a very carefully crafted statement, and up to now, across different administrations, America has, broadly speaking, maintained a consistent approach with that policy. And if it does so, I think there will be a good chance of us maintaining peace and stability in the Taiwan Straits.
You also talked about a post-American order, which sort of interested me because it implies that America's move towards isolationism and protectionism is not just Donald Trump, that even after he goes back to Mar-a-Lago or heaven, or what, maybe he doesn't know the difference, that America no longer will be a champion of globalization, no longer be a sort of partner that you can rely on in the same way as you did. Do you really think that America has gone?
We hope not. When I said post-American order, I was referring to the forces that are driving us towards a more multipolar world. Yeah. So the unipolar moment where America was the leader that helped to guide, underwrite the global system, that moment I think is over. So the old rules do no longer apply, but the new ones have not been written. But as we transit into this new multipolar world, it's not as though every pole remains the same. America is still the biggest, most powerful country, and still maintains, America's leadership remains vital. And we certainly hope that America will be actively engaged in the world. Maybe not now, maybe not with this administration, but there will be a time when America can take up its role, be actively engaged, constructive, and continue to have good relations with all its key partners. America's role is critical for stability and continued prosperity in the world, and the world needs America to behave like that.
To look at from the outside, America's policy towards China seems somewhat schizophrenic. On the one hand, there is a very strong desire to keep China in check. On the other hand, most people would say you keep a country like China in check by bringing all the other allies, all the people in the region onto your side. And yet, as you pointed out, when tariffs happened, Trump has hit everyone with a variety of things which would not seem like ally-like behavior.
I visit China regularly just to find out how things are developing. And all the actions that America takes vis-a-vis China has, in a way, only strengthened their resolve to work even harder, to move faster on technology self-sufficiency, and they are determined to grow. So one China commentator tells me there's nothing America can do to stop China. Only China can stop China. And when I heard that, it reminded me of something I heard a long time ago about the US too. There's, Abraham Lincoln once said, if destruction be our lot, let us, Americans, be the author and finisher of it. And so it strikes me that
I think that was shortly before a civil war, but so it may be rather bad.
But it strikes me that in this great rivalry, everyone is focused on what one country does to another.
Yeah.
But really, the fates of these two great powers will be determined by their own people at the end of the day. Americans decide Americans' future, Chinese people decide Chinese future. That's what it comes down to, and it's their actions, their agency that determines domestic reforms, that determines the direction that these countries will take.
In terms of Singapore's position in that world, I mean, I suppose if I was to look at Southeast Asia, I must have been coming here for 3 decades or around that. When I first came, I think there was a general presumption that if things came to a head with China, most of Southeast Asia would probably stick with the West. You look at what's happened over the past year, that's become Southeast Asia, including Singapore, has become home to many more Chinese companies. As I said, Donald Trump hit the allies with tariffs. Joe Biden wasn't that kind to you either. Your first visit as Prime Minister was to Beijing, outside ASEAN, was to Beijing, not Washington. I mean, is America losing this region?
Yeah. We've put a request to visit Washington,
yes,
waiting for the dates. but I wouldn't read too much into these sorts of things. But
that's indicative, isn't it? You would imagine an American president would want to see one of his main allies.
Where I go, what countries I visit, and I also wouldn't say that in the past it's very clear-cut that countries would side with one side, the West, and now would side with China, and things have flipped. I think that's too simplistic a portrayal. There is no doubt America's actions over this recent period has impacted America's standing in Southeast Asia. All the surveys would suggest that, and it's very clear-cut. But I think there's still tremendous goodwill and desire for ASEAN countries to engage the US. President Trump came for the ASEAN summit meeting. He presided over the peace accord between Cambodia and Thailand. And then he sat down for a meeting with all the ASEAN leaders, patiently listening to each one, engaging and listening to each one. And at the end of all the interventions, said that America and him personally is committed to ASEAN. I think that's well received by ASEAN. In the previous administration, Gina is here, Secretary Raimondo. We worked on the IPEF, Indo-Pacific Economic Framework, under the Biden administration. And many Southeast Asian countries welcome that, because America is still the largest investor in this part of the world in terms of FDI. And all the countries look forward to having more linkages with America, more engagement with America, more investments from the US. So, yes, America's standing has taken a hit, there's no doubt. But we hope America can recover from this, and we would like to see America recovering from this.
Just on that, you've spent quite a lot of time, though, talking about a multipolar world, and one where you've tried to, I suppose, bring together what may be described as a coalition of the willing, of kind of free trading countries that would deepen ties and that would sort of get on with the business of globalization, whilst America and China go about building walls of different sorts. But that particular way, what can you do with that in practice? You've accumulated a group of countries. What can you actually do? It's the sort of, is it just about having slightly better documentation and things? What is the end of that?
Let me put it this way. The stable multilateral framework that we were all familiar with is unraveling. That framework was optimized for trade efficiency. In today's world, countries are more concerned about security and resilience. So countries everywhere are prepared to accept some inefficiency, higher cost in return for higher security and resilience. But this is now being done unilaterally, country by country taking its own actions. And that's just not sustainable. In the worst case, you will end up with something that, like what happened after the Smoot-Hawley tariffs in the 1930s. Someone does something, another one retaliates. There will be a dynamic where it's just escalating. And before too long, we will end up with devastating consequences. On the other hand, we know that the WTO, which was meant to solve these problems, isn't working. We would like to see a new framework in place. It's not easy to get that happen now, but ideally a new framework that finds ways in which countries can legitimately exercise and protect their own national interests, but with restraint, with some shared rules, and not on the basis that you can unilaterally do things to coerce another country or to punish another country, which is somewhat happening now. So how do we get there? And I think it's very hard for all of us to imagine ways to get there, but I think we should not give up trying. And that's what we would like to do, which is work with like-minded countries. Some of the, we have a future of investment and trade partnership with 15 or so countries doing this, but also working with the WTO, working with regional groupings like the CPTPP and the EU. And all of these efforts ultimately are not just about tariffs. They are about setting new norms, new rules of the road that would allow us to facilitate trade and investments and find some way to ensure supply chains remain resilient and secure. And in a way, we are laying the foundations for a new multilateral framework that may come later on.
I looked and saw the Future of Investment Trade Partnership, FITP, as it's known, and the members include group is Brunei, Costa Rica, Chile, Iceland, Liechtenstein, Morocco, New Zealand, Norway, Panama, Rwanda, Singapore, Switzerland, the UAE, and Uruguay, which is a fantastic kind of World Cup group to be in. But it doesn't feel like the beginnings of a big trade bloc.
I know, but don't sweat the small stuff. You know how the TPP started and the CPTPP started? P4. Very small countries, 4 tiny economies came together in the P4. That became the TPP, and when America decided not to continue, we had the CPTPP. So great things can start from small places, including Singapore.
What about something you've already? What about something you've already got, which is ASEAN?
Yeah.
And you are next year, 2027, you take over the chairmanship of it. And you look at ASEAN, as you say, it's been very successful at preventing conflict.
Yes.
It's become a kind of grouping. When you tried to negotiate with Trump as a group, he slightly sort of pushed it aside and made you negotiate one with each other. I wondered, is there a way of making ASEAN into something bigger, something deeper? At the moment it's based wholly around consensus. Could you ever move to something like a majority agreement instead? I hate to mention the words European Union in a good light, but if you were to take it a little bit closer to the European Union, does that make sense?
We certainly want to integrate faster and bring together the single market. I mean, there's so much that still needs to be done, but we also have to recognize that wide diversity of ASEAN, countries at different levels of development, and so we move as fast as we can. I would say that it was not so much that the US didn't want to negotiate with ASEAN collectively. It's just impossible given the diversity in ASEAN. ASEAN would not be able to negotiate a trade deal with America as a collective. It had to be country by country. We are not quite there yet to negotiate deals like that collectively. But ASEAN has its advantages and strengths. When we talk about ASEAN centrality, for example, it's not as though it means ASEAN dominates everything, but it means ASEAN has pooling power as a convener. And precisely because of the fracturing of the global economy that we see now and the uncertainties, more and more major powers would like to strengthen their links with ASEAN. EU is interested in an FTA with us. The GCC, we've been talking to them. Canada is interested in an FTA with us too. So we are discussing these initiatives very seriously, and hopefully we'll do this next year when Philippines is chair and when Singapore chairs ASEAN in 2027, we hope we can continue to build on the foundations and make progress.
So the way in which ASEAN would grow would probably be going broader rather than deeper. You're not going to end up with a...
We have to do both.
Do both.
I think we have to go deeper as well, but it's just that going deeper takes time. It's not straightforward, and countries will be able to move at different paces. And in some instances, we may very well say the countries that are able to move faster do first. I wouldn't rule that out.
When we talked about the region, you said you didn't think there was the war coming on or anything like that, but there is. Do you think in the end, a country like Singapore will have to choose between China and America? You've managed to avoid that so far.
Yeah, another favorite question.
Yes, it's coming that way. Journalists are notoriously unoriginal, but the problems don't change. No, the choice is arguably getting bigger.
The pressures will always be there. The great powers say we don't want you to choose, but of course each one wants us to be a closer friend to them. And that's always, the tension is always there, the pressures will always be there, but at the end of the day, we don't have to choose, really. We have to, it's not issue by issue. There will be some instances where we look at the issue, and we so happens that the particular position we take is the same as the US, for example, or as China, for example. But it's not from the lens of choosing one versus the other. It's from the lens of Singapore's national interest. And that will always be the case for us. And it's the same, not just for Singapore, it's the same in ASEAN. ASEAN countries feel the same way. We have been the arena for proxy wars before. It's been such a painful experience. We don't want that to happen again. And so ASEAN will continue to be fiercely independent. Not so much non-aligned, but multiple aligned. Engage with all the key players.
On that subject, hot war, but there's a lot of Cold War going on, and there's been this issue about state-sponsored cyber attacks, people interfering in the election. Your party complained about that in the election you won. You've had cyber attacks, and you're going to adjust, I think, your foreign interference law further.
Yes.
And I wondered, are there any particular countries you're worried about? Is it China, Malaysia, Indonesia, or all the above?
We don't call out our adversaries, but we know who they are.
It's a good way to be around. Can I ask a bit about...
And we are not naive.
Can I ask about Singapore as a financial hub?
Yes.
You've had this onrush of money coming here. You've had this big push to lure people here, the family offices, you see many of them here. A lot of wealthy people coming here. And you get two issues from that. And the first one is this issue of inequality, which I know the Gini coefficient has got better, so that in income terms...
In income terms.
Income terms getting better. But there is this, every time I come here, people talk about inequality more.
Yeah.
And I wondered, you've already introduced taxes on luxury cars and properties, but do you see Singapore moving towards other things, a capital gains tax, for instance?
Two separate issues, really, because wealth management, Singapore is a financial center. I think we can grow in terms of wealth management. Family offices may set up here. They are not Singaporeans. They, have their offices here. They manage their funds out of Singapore. We welcome that. It creates jobs for Singaporeans. I think that's a good thing, and we can explain that to Singaporeans. Sometimes it creates frictions, especially when there are ostentatious shows of
Ferraris and things, yes.
And we have just to remind them that, Singapore is a different society. We are egalitarian, our norms are different, please understand. And for the most part, they do. Tackling wealth inequality where it comes to our people and our population, that's something we continue to work on, whether it's income or wealth. We have a range of policies. It's not just about tax alone, because in Singapore, we have the ability to also provide wealth injections. And a major reason why we can do that is housing. Almost everyone owns their own home. Majority live in public housing. And when you buy a flat from the Housing Development Board in Singapore, you get housing equity. And that's the reason why even at the lower end of bottom 20% of households, actually they have significant net wealth net asset value because of home ownership. So that's one way we can continue to fine-tune our policies to provide more support and uplift for lower income groups. We also have a Central Provident Fund, which is Social Security, which is the individual's own retirement nest egg, which we do top-ups from time to time. So our tool sets are not limited. I know there's a lot of interest. Again, yes. Bloomberg's favorite question for me.
Capital gains
tax, wealth tax. A lot of questions about tax, but our toolkits are not limited to tax alone. We also have wealth transfers.
I'll take that as a maybe. Just the other issue about a lot of wealthy people coming here is that not all of them have been virtuous, if I can put it that way. You know, you had the money laundering.
Yeah, we've got illicit flows.
Yes, and you had the accusations about, from the US, about one of the heads of the main Asian crime families being here. You've dealt with these things, but there is, and one of your ministers had a very nice Chinese saying, when we open the windows, some flies may also enter.
And sometimes we get more than flies.
Yes, but how many flies can Singapore tolerate, and do you need a bigger fly swatter?
We do have quite a big fly swatter. I mean, we take it very seriously. It's not unique to Singapore. The illicit flows are everywhere. All financial centers have to deal with this. So to us, it's not so much about that there is an incident. There are bound to be incidents, and there are bound to be suspicious transactions, and then with intelligence, with cooperation across different countries, eventually we get to the bottom of it. The key is, what do you do? And we are very stringent, and we take swift action. And we are determined to protect our reputation, because that's what keeps Singapore going, a trusted business and financial center.
Can I ask you about energy? I've been quite struck, being here for the past day or so, is that a lot of people are talking about all those new data centers.
Yes.
The idea that AI particularly will need more energy. You look at Singapore energy at the moment, virtually all of it comes from LNG, very successful. But the idea that somehow in the end, Singapore has to kind of get energy of its own, and there you're really in a choice about either trying to do something with one of your neighbors, maybe a renewable thing or whatever. The other big, very obvious option is nuclear energy. I mean, is that something which is going to become a much bigger part of Singapore's future?
We don't know yet, but we are certainly studying the options seriously. There won't be an easy silver bullet in our case, because we are small. We are unable to scale up renewable energy in terms of the amounts that we need. Some of the solutions, as you highlighted, would include plugging into an ASEAN power grid, which we are building, taking time, complex, but it's happening. But still, we would like to have our own source of clean power. Hydrogen might come up as one possibility, but it's expensive. So you could ship hydrogen and then burn it through a turbine. It's got lower emissions than LNG. That's possible. But we are also studying the possibility of nuclear power, especially when you look at some of the new technologies with SMRs, which are safer. We are looking at whether it might be possible in our context. We are very small, 750 square kilometers, or less than 300 square miles. That's tiny.
Yes.
So we have to take it. We have to look at it, consider the safety very closely before we decide, and look at the technology and how it's evolved.
Is there a kind of time scale on that? When do you think Singapore?
It really depends also on how the technology evolves. And as of now, we've been looking at different technologies. You don't really see very many operational SMRs, particularly small, the SMRs which are grid scale. We're not talking about the tiny ones like 50 megawatt. Those don't serve our needs. Right? We're talking about grid scale, commercial scale SMRs, and you don't see a lot of them around as of now. And so we are studying, looking at, we are working with partners, including America and others, Europe, looking at the technology, understanding it better, understanding the implications. And then if we think it's possible, we will have to also convince the public that this is indeed a technology that is safe and deployable in Singapore. But we are not there yet. We are still at the very early stages of building up capabilities.
many things about you and ask you a personal question at the end. You know, you're the first leader to be born after Singapore declared independence.
Yes.
You're also only the second leader outside the Lee family. And I wondered...
We only had 4 prime ministers in Singapore.
Not many people have had 4 prime ministers for that long. What makes the biggest difference to you? Is it that generational thing?
Difference in terms of?
Well, in terms of the way that you want to go ahead, that you are somebody from a new generation of Singapore. Does that make a bigger difference to the way you want to lead Singapore over the next period?
I suppose me being from a different generation is part of it. But in terms of ethos, mindset, values, I represent the party, and the foundational values remain the same. We are here to build a better Singapore because history has never been kind to small states. And we know, despite our success these last 60 years, the world is a dangerous place. It's become even more dangerous. And our mission, my mission, is to keep Singapore going, not just in my term, but to leave behind a better Singapore for my successor and for future generations. So that remains the ethos, the foundational values in which my party represents, which I represent. I keep going back to this very vivid memory of when I was in Michigan studying. I've told this story before, but not all the guests here might know this. There is a ghost town in Michigan, and it's called Singapore. Truly. It was founded
was it based around free trade and minimal government?
I don't know. It was founded in the 1830s near Lake Michigan. Why Singapore? Perhaps 1830s. Perhaps it took inspiration from the fact that in 1819 there was this exotic port in the exotic Far East founded by Sir Stamford Raffles. And so maybe the name traveled. It took some time for things to travel in those days. And perhaps it took inspiration from that. But Singapore and Michigan didn't last very long. I think about 50 years. It's overwhelmed by the sifting sand dunes. And now there's only a marker that says this is where Singapore, Michigan stood. We want Singapore in Southeast Asia to last for a very long time. That's my mission.
Well, we all hope you achieve that. Thank you very much, Prime Minister, for talking to us. And thank you very much for hosting us here.
Thank you.
That was the Bloomberg editor-in-chief, John Micklethwaite, alongside the Prime Minister of Singapore, live from Bloomberg's annual New Economy Forum. Plenty more still to come on Bloomberg TV and on Bloomberg Radio. If you're just joining us, welcome to the programme. Equity futures on the S&P firmer by 1/3%, following a 4-day slide on the S&P 500. Earnings very much in focus. Target earlier on this morning did not impress. Later on tomorrow, you'll get Walmart. Later on this evening, you'll hear from Nvidia. Let's turn back to the economy. The Trump administration looking to provide $2,000 tariff dividends to U.S. consumers. The Treasury Secretary, Scott Bessent, telling U.S. media families could save the checks.
Would a $2,000 tariff dividend check be inflationary?
Well, there are a lot of things that are going to happen next year. That could be one of them. And again, maybe we could persuade Americans to save that. My prediction is that first quarter, second quarter, what we are going to see is we have brought the inflation down.
Can you persuade Americans to save that $2,000 check?
Good luck. How would you persuade them? You're going to get a sale. You'll get a Birkin bag in December.
Seriously.
Yeah, I mean, honestly, try that with kids.
$2,000 getting spent almost immediately. Libby Cantrill of PIMCO has this to say. We're very sceptical the Republicans in Congress at this point are interested in adding more to the deficit with another tax cut. Libby joins us now for more. Libby, good morning.
Good morning.
There's a shift at the White House. Affordability in focus, new initiatives. Where's this shift coming from, and is it durable? Is it sustainable into next year?
Yeah, well, I mean, yes, there is a shift, and obviously it was precipitated partly at least by the election 2 weeks ago when Democrats, if anybody who had a D, on the end of their name, basically did well. And most Democrats did run on affordability, probably in some ways learning the lesson from 2024, where they didn't sort of lean into that issue
as much. And so now the White House, I think understandably, a little bit like how President Biden did in 2021 and 2022, maybe in vain, is trying to shift more to affordability. I think there are obviously limitations to what the president can do unilaterally. And I think Secretary Bessent understands those limitations. You do need Congress in order to cut taxes, even if the revenues that are going to offset that tax cut would come from tariffs, which obviously were put through unilaterally. So we are skeptical. Now, with that said, and this is something we think that the market is obviously focused on, is that there will be a really nice, healthy tax refund come next spring. I'm not even sure Americans actually realize that they're going to get such a nice refund. But, on average, households will likely receive $1,000 kind of plus, sort of depending on their tax bracket and their tax situation. So that could maybe, have the same effect. But in terms of an additional tax cut paid by tariff revenues, we think it's very unlikely.
What do you think is on the menu? So we've seen some tariff relief already. We've seen the prospect of a $2,000 rebate check. We've also had a conversation about 50-year mortgages as well. What else is on the menu?
Yeah.
What other proposals are
So, obviously, the reduction in tariffs for foodstuffs, for beef, for coffee, for bananas, a little bit of a tell that maybe tariffs do raise costs, at least incrementally. And then, obviously, the 50-year mortgage, we, again, skeptical that actually goes through. Lots of issues with that. Maybe provide some upfront affordability, some cost savings in terms of mortgage payment, but obviously reduces the amount of equity that folks are able to build in their homes. Is not TBA eligible, to be very wonky, so probably has a liquidity issue as well. So I think the upshot is that we think that's unlikely. Of course, the real issue with housing, as we all know, is supply. And so trying to incentivize developers and folks to build, that probably takes Congress as well. And there's some things that they can do from a permitting perspective unilaterally, but really difficult even on the federal level. So I think the upshot here is there just limits to what the president can do unilaterally. He can talk about it, but he probably needs Congress to do most of it.
But what we learned from the midterms, and I'll call them the midterms, because that's essentially what they were, is that there is this shift to affordability, and there seems to be bipartisan support to really help consumers with the cost of living concerns that they have. It is a bipartisan issue politically. Why has the vibe shift not moved into materially higher long-term yields if you have bipartisan support to reduce the amount of tariffs, to reduce the amount of cuts just broadly to government, et cetera?
Yeah, it's a good question. I think we've obviously, of course, as you all know, the curve has obviously steepened a lot over the last year, and so it still remains relatively steep, at least relative to the very kind of flat yield curve that we had seen, for years previously. So in some ways, that term premium has come back a little bit. But there still is a bid, obviously, for treasuries. There's, we always say the kind of the cleanest dirty shirt, this expression of Bill Gross's, our founder at PIMCO, used to talk about kind of there is no alternative. You have a lot of dirty shirts. You wear the cleanest dirty shirt. Doesn't look great on an absolute basis. Looks good, pretty, relative to the other shirts. And I think that still stands. So, there is going to be some natural limit in terms of how, at least right now, how high the 30-year, how much that term premium does expand. But all things equal, if you just go back to where we were back in October of last year, the yield curve has steepened.
Yeah, I just wonder if bond vigilantes have either gone to sleep or never existed, right? Because at a certain point, we're talking about the deficit that at one point was the rallying cry for people who are saying yields are going higher, and all of a sudden we're looking at the potential rollback of tariff revenue, the potential addition of policies that could potentially support consumers, whether that $2,000 gets passed or not. Yeah. You're talking about a bigger deficit. Suddenly nobody cares. What's the deal?
Yeah, and we've been talking about kind of the 6-7% deficits really for the foreseeable future. I have teenagers at home.
Well done, 6-7.
But really over the foreseeable future. And that was our view going into this, that regardless of who won the election, the deficit would be the biggest loser. That has obviously come to pass. And nobody is talking about sort of fiscal responsibility. They're not talking about increasing taxes or changing entitlement spending. And that's really what you actually would need in order to change the fiscal trajectory. But the same thing, just from an investor's perspective, people are looking at the U.S. as the sort of source of growth, right? If you just look at what's happening, obviously, with AI, with labor mobility, still immigration, the dynamics of the U.S. economy are still much more attractive than the other developed, rich world. So I think there is a little bit of that where there's just going to be kind of demand, at least as of now, for our debt because of those dynamics.
I cannot believe 6-7 made it to Bloomberg.
Sorry about that.
It's okay. I think that it's great.
And Libby Cantrill made it happen.
Honestly, my kids would be so proud.
You made us relevant because right now that is ultimately relevant.
Guys, we're farming.
Yeah, exactly.
Nice, okay. Let's not take this too far.
I'm going to get an email from our PR people, definitely.
Where is Libby taking this? I think PR at PIMCO are confused already. Libby, I want to finish on maybe a fracture in the Republican Party. Congressman French Hill was on the programme a little bit earlier this week, and he made the point that he didn't like broad-based tariffs. And he's typically very diplomatic, but I think a little bit more vocal now. We're starting to see signs of the Republican Party on the Hill. It's pushing back a little bit to the White House. Are you sensing the same thing?
Yes, I mean, obviously the vote on the Epstein files was a little bit like that, just sort of put the exclamation point on that sentiment. I do think that, and this is actually a bipartisan phenomenon. If you just look at the Biden administration, at the end of 2021, the coalition around Democrats was fracturing then as well. So there was more pushback on President Biden by his own party. I think the same thing is happening now, right after the off-cycle, the midterm election of 2 weeks ago. You are now seeing that political runway for the president shorten. And again, this is, I think, pretty consistent with history. But I do think you will continue to see more pushback. And as it relates to fiscal policy, tax cuts, adding to the deficit, a lot of Republicans very uncomfortable with that. I also think it has implications for the Fed chair in terms of who's actually the nominee. You may see, if the president were to nominate somebody who was viewed as not independent, was viewed as too political, I think that Republicans are increasingly feeling a little bit more comfortable to push back. They have been privately, but maybe more publicly as well. And again, pretty consistent with other cycles in history.
Do you think just finally that could lead to a sensible Fed chair choice?
That has been our view.
We think
that there's going to be a much more conventional, orthodox Fed chair than I think a lot of people at least feared in the market. Yeah,
that's what sensible is to me.
That's right? To me, right? That's exactly
he would be the easiest. He would be the easiest.
Who do you think the president believes is politically correct? What does that mean to the president?
Yeah, not sure. But I think probably somebody who's more familiar to Washington. So whether that is Governor Waller or Kevin Hassett, somebody who's going to be a little bit more familiar.
Seems like different characters. I don't know.
Very different.
6, 7.
Libby, good to see you. Oh, nice. Okay. Aura farming again.
Aura farming over here, guys.
Overwhelming. Okay.
Never getting invited back.
Libby, you'll be invited back. Thanks for being here. Libby Cantrill of PIMCO. Thank you very much. Whether PIMCO lets you come and talk about that again, I don't know. 2 hours away from the opening bell. Let's get you some single names, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Some earnings from the retailers to work through this morning, starting with Target. Those shares sliding 2.4%. They trimmed their outlook on the high end. It shows maybe this turnaround that they've tried and been effort is going to be taking more time. They also announced about $5 billion of capital expenditures on things like opening new stores, refurbishing the ones they have, and investment in merchandise. So again, those shares falling. We also heard from Lowe's earlier this morning. For them, it's been a rocky road. They're down 11% this year. They fell 2.5% yesterday after the poor earnings from Home Depot. For them, it was a beat for the current quarter, so that was enough to uplift shares. Those are higher by 6%. Finally, about 10 minutes ago, we heard from TJX. That was a beat, too, for the third quarter. This is one of those companies that, of course, is selling discounted merchandise. So if there is stress among the consumer, it's one that you'd expect to do well, and doing well it is. And they also improved their margins. They're at 11.6% net of taxes. So those shares up 2.4% in the pre-market, John.
Danny, thank you. The latest on TJX and some of the retailers this morning. More still to come, as Danny pointed out. We'll hear from Walmart tomorrow morning. Let's turn to the labour market data. Investors eyeing the long-delayed September jobs report due tomorrow. Francis Donald of RBC writing, we think fourth quarter data will likely add more confusion than clarity. Francis joins us now for more. Francis, welcome to the programme. If we're going to be more confused than clarified, what does that mean for that decision on December 10th?
Well, it means the Federal Reserve is going to be more confused and clarified. And the Federal Reserve, just like markets and economists, are going to have to think a little bit further out into what Q1 and Q2 are going to look like. And probably that tells us that employment will become slightly more problematic, not dramatically, and inflation will continue to rise. It's a continuation of that stagflation light type of environment. And even if we have a bit of a hole here in a couple months of data, looking through, our view is still the same, which is growth is going to be slightly below comfort level and inflation is going to be slightly above. And that will be the situation that this Federal Reserve and future Federal Reserves will likely continue to have to deal with.
What are you looking at to confirm that view? We know that September data is going to be backward looking. Yes, we get that tomorrow. We know that October data is going to be muddy at best, confusing at worst, and potentially might even distort the picture further because of the government shutdown. And it's unclear what CPI data we're going to be getting. So what are your benchmarks right now?
We definitely have enough on the job side from a variety of private sector data in order to give us a sense of the momentum. Do we know the exact level? No, but we know it's sort of soft, stabilizing, enough to bring us towards our forecast to an unemployment rate of about 4.6 later into 2026. So that in and of itself, we can see the big problem is on the inflation side. That's where we have really minimal perspective. We don't have the ability to see much of what happened in October, and we're probably not going to get full clarity on what that level looks like until early in January. And actually, you don't even get the January data until February of that month. But I think one of the stories here is that we get so obsessed with month-over-month data as if we need to see what happened last month or 3 weeks ago to know the trend of the economy. And the truth is, we don't. We actually have the ability to map out over an extended period of time. That's why economists have 1 year or 5 year forecasts, because if we know the direction, we can make various assumptions. And our assumption is that we have not seen the inflationary impact of tariffs as of yet. We are still drawing down on inventories in the United States, and we're likely only going to start seeing that real pressure on inflation in early 2026 and in the middle of 2026 going forward. So we can maintain those assumptions even if we don't have week-to-week maybe obsession over what the exact level will be.
One thing that a lot of people said during the pandemic was listen to the companies. The companies have the front view in terms of how to plan their businesses. We heard from Lowe's, we heard from Home Depot, we heard from Target, kind of a motley picture here. Are you getting a sense from the retailers, from the consumer-facing companies, of a picture that gives you more clarity heading into 2026?
Absolutely. We're looking for anyone who can give us information. I might add things like the Fed's beige book into that story. So some of the anecdotal evidence that some of these core themes are coming through. The big thing we're seeing really now accepted in the broad-based narrative is something we've been talking about for well over a year now, and that's that concept of the K-shaped economy. And while I think there's still maybe a little bit of a view that that just means the haves are getting richer and the not-haves are getting worse off, I don't know that we've really internalized how this is changing the dynamic of consumer spends. That we've got some consumers that are trading down, and that benefits some companies, and we've got other consumers that cannot trade down at all. It even flows into conversations of, for example, potential $2,000 checks to American households. Will that be inflationary? Not for the lower part of the K, who are still really struggling with affordability crises. So we're looking for sort of evidence of what the shift in the consumer is really doing. And I'll add on top of that, it's not just a K-shaped economy, it's also an increasingly retired consumer. What are those spending habits looking like? Because this is really a consumer that we haven't seen for many decades in the American economy, and any type of anecdotal or hard data that we can get on it is very helpful in constructing that narrative and helping companies navigate an increasingly difficult operating environment.
Francis, I don't expect you to get deeply philosophical when I ask this question, but just to take a step back, what has gone wrong in the West? Why do people hate these economies so much? Because it's not unique to America. I see it across Europe as well. What's gone wrong here since the pandemic, and what can we get right?
Well, when we look at the data, which is the economist's perspective to the philosophical questions, what we see is really a break in 2023. And it comes back to this perspective that historically, while, the wealthy spent more than the not wealthy, most of the economy followed the same economic cycle. So if your upper incomes were doing well, so were your lower incomes. It was tides that lifted and sunk all ships at the same time. So even though maybe some had more than others, it really felt more egalitarian, that we're all sort of following in the same economy. After 2023, and that's where we see the data really start to break down, that's when we see that the haves, or the upper part of the K, are really experiencing an entirely different economy and a different economic cycle. And this is, I think, the biggest question for the Federal Reserve. It's not who's going to be the chair, is that how does policy act in an environment where interest rates impact everybody at the same time, but some areas of the economy require different interest rate policy? What about things like fiscal policy? It has to become extraordinarily more targeted. My concern heading into 2026, if you've asked me to be philosophical, is maybe that lowercase k becomes even a uppercase K, because we're going to see things like changes to the SALT cap deductions. That's going to benefit the upper part of the K. Financial markets doing well benefit one side, and we still haven't seen any material relief on the affordability side. So when I talk to clients about the K-shape, they say, well, what solves it? And my answer to them is you should really think about this as maybe semi-permanent type of dynamic. It's not going away anytime soon. And if you're a company trying to figure out how to service your clients, you have to be really, really aware of what part of that K, or maybe we should increasingly call it a fan, you need to be looking at.
Francis, super well framed. Appreciate your time. Thank you. Francis Donald there of RBC. That was bang on the money, almost perfect. This is not a perfect parallel, but thinking back in history and monetary policy, same challenge for Draghi. in the Eurozone debt crisis. There was an interest rate that the rest of Europe needed, particularly the South, and there was an interest rate that Germany thought it needed. And it was completely different. Two completely different economies, different worlds existing at the same time, and a monetary policy committee trying to set policy for both worlds. You can't.
And this really is going to be the key question. Do you cut rates to try to cater to people at the lower end of the K, the bottom part of the K, even if it benefits potentially disproportionately the upper leg of the K, which is what we saw after the pandemic? Or do you keep rates solid and potentially damage the lower part of the K even more? It is not a good choice to have to make, and yet this is where we are.
Not easy at all. Equity futures this morning on the up. We're bouncing back by 0.4% with an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. China made its biggest daily purchase of U.S. soybeans in 2 years, signaling support for last month's trade truce. President Trump says he still wants China to speed up its buying, even as U.S. soybeans trade at a premium to Brazil's crop. Meanwhile, former Treasury Secretary and Harvard President Larry Summers has resigned from the board of OpenAI. Summers and the startup released separate statements after Congress released new emails between Summers and the late disgraced financier Jeffrey Epstein. And Elon Musk's foundation gave away a record $474 million in 2024, with the vast majority going to entities he controls. The bulk went to a STEM-focused nonprofit. He also gifted to groups focused on healthcare, disaster relief, and education. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, cashing in on AI.
There is going to be an incremental degree of kind of skepticism and scrutiny that's done on a lot of these bond deals and transactions, thinking about, what is the actual useful life of the things that these companies are investing in.
Up next, we'll catch up with Ashok Bhatia of Neuberger Berman, live from New York City. You're watching Bloomberg TV. Live from New York. Welcome back. Equities look like this morning on the S&P 500. Going into the opening bell, we're firmer by 0.4% later on this afternoon. Earnings from Nvidia. And a surveillance this morning, cashing in on AI.
The AI value chain is not only in the tech sector. It spans across a lot of sectors that are very capital intensive, especially utilities. There is going to be an incremental degree of kind of skepticism and scrutiny that's done on a lot of these bond deals and transactions, thinking about, what is the actual useful life of the things that these companies are investing in, especially as a lot of these bond deals are not just concentrated in the front end of the curve.
So here's the latest this morning. Global bond issuance surging as big tech races to turn AI dreams into reality. Ashok Bhatia, the CIO and global head of fixed income at Neuberger Berman, writing many issuers are well positioned to leverage AI advances to deliver cost efficiency, enhance productivity and unlock potential growth drivers. Ashok joins us now for more. Ashok, good morning. Good to see you.
Good to see you.
We've seen a lot of issuance from some big players. Is the market starting to push back?
A little bit, but I think the important, just to take a quick step back, these AI hyperscalers have been issuing about $30 billion of debt a year for the last 5-10 years. In the last 2 to 3 months, they've issued $90 billion. So in the space of a couple of months, we've done triple the volume. And it's hitting all parts of the bond market. It's hitting corporates, it's hitting asset backs, it's hitting the private markets. Now, I don't think the bond market is pushing back that much. Microsoft credit spreads have moved from 30 basis points to 60. And the reason for this is that these companies have a ton of free cash flow and very low leverage. And even something that's in the news about Oracle has widened from maybe 120 basis point credit spread to 180. So I think there's a lot more noise and concern about this than is being really reflected in credit spreads
Indexes
today.
change over time. I remember more than a decade ago, I used to talk with Lisa about it all the time. High yield was all about energy. Things change. This market's changing too. When you start to see an industry take over the issuance, the net new issuance, what does that mean for how you trade and invest in that market?
Well, it's a great point because the AI issuance at this pace, it'll become 5 to 7% of the index. So it is going to go from a very small component to something meaningful. And I think, if you look back, a big investment cycle that is debt financed with a lot of uncertainty about how the winners turn out, intermediate term, long term, that has a lot of risk for bondholders because, with AI, a lot of the productivity and the gains, it's unclear if the hyperscalers will get all of it. Will it go to other parts of the value chain? Is this a winner take all, or will there be multiple winners? But ultimately, as bondholders, the best we get back is par. So we, the bondholders, are going to ultimately absorb any downside in how this is being financed, while the gains go to the winners in the equity markets. And that's something I think everyone's got to be very cognizant of.
Are you staying away from this debt?
We're being pretty selective. So what we're trying to do is own things that are on the balance sheet, so it is corporate unsecured. We're trying to avoid things that are highly structured where, some of these deals involve, you're financing chips, you're financing real estate, you're financing the overall capital, the cash flows of the corporation. And we're trying to stay a little bit more at the corporate cash flow level and at the margin try to avoid some of those other risks right now.
Which raises the question of who's getting the better deal, the public corporate bondholders or all the private debt investors who are investing in some of these huge asset managers that have taken an increasing footprint. Brookfield this morning announcing a $100 billion infrastructure fund. I mean, do you have a sense of that?
I think this one is going to take a while to play out because, just a couple of the quick, uncertainties about this. A lot of this debt is 30 to 40 years. Chips have a useful life of 4 years. Now, there's an argument that those chips can be valuable and cash flows longer. The plants, we're financing the construction of these facilities. Well, the facilities have use if you can get energy and how that's all going to play out. So I think, our guess is that the structures, whether it's held in public or private, will be more determinative of the outcomes longer term rather than this is public good, private bad, or vice versa.
We've had some market volatility over the last few weeks. We haven't seen much of an offset in the Treasury market. I just wonder how you're thinking about things, the front end of the curve versus the long end. Tend to have been pretty stable in this environment, about 4.1%. Is that good news? Is that bad news?
I think people are looking at it saying it's bad news, right? The Treasury market can't rally on bad news. But I think there's two things going on. One is I do think some of this long-term debt issuance that's come up from the hyperscalers is impacting yields. The other is Japan, right? We still if you look at the global bond markets, Japan is the one that it continues to trade pretty weakly. So I think we need some stability there. But our view is, the funds rate is coming down, whether it comes down to 3%, 3.25%, 3.5%, it's coming down, and that will help stabilize long-term yields.
Is Japan re-anchoring the global bond market? Bond yield higher?
Yeah, I do think that is a theme that has been there for the last 12 to 24 months, and it is not going away. I mean, Japan just exports so much capital, and that Japanese buyer who is looking at, can I buy JGBs, or can I come to the U.S. or come to Europe? That's a decision they're making every day, and we have to be more attractive if JGBs keep going up.
Waiting to see if that great repatriation develops or not in the coming months and years.
I love it. Yeah. So if you're a Treasury buyer, just analyze Sanai Takaichi's budget.
Basically.
And potentially the independence of the Bank of Japan, and you might have a clue of which tenor to invest in the U.S.
It's a tug of war right now between risk aversion on the one side and what's happening in Japan, and the additional supply on the other side.
It just highlights how the 30-year, the 10-year really are international markets, and how difficult it is for the Fed to get a control over this at a time when the mortgage market really is hinged on this key rate that is instrumental in getting the housing market back up. I mean, it's just we're tying ourselves in knots because, frankly, this is a complicated backdrop, and it's hard for one entity to have too much control.
It's not going to get easier, not anytime soon. Ashok, good to see you.
No, great to see you.
It's been too long, sir. It's great to see you in person.
No, it's great to be back here in person.
Thanks for being here. Thank you. Ashok Bhatia there of Neuberger, Berman. Coming up, Alicia Levine of BNY, Beth Kindig of the IO Fund, and Erin McLaughlin of the Conference Board. The third hour of Bloomberg Surveillance is up next.
The data center and AI build out is going to be extremely expensive. That's starting to weigh on the market a little bit.
There is an expectation that we'll start to see a leveling out in Mag 7 earnings growth rates.
I still think there's probably some room to see more pullback.
New leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
6-12 months ago, the fundamentals looked better. We're more on bubble watch than bubble call.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive by a third of 1% on the S&P 500. On the Nasdaq, up by 0.4. Similar move on the Russell. Following a 4-day slide, equities bounced just a little bit. The numbers from Target this morning, not great. Tomorrow, Walmart. Later on this afternoon, the big one. The weight of this market on the shoulders of Nvidia reporting after the closing bell.
Yeah, and it already has lost more than $600 billion of market capitalization since the end of October when it saw its peak. And this comes as people are not rewarding the idea of spending more without showing the results. And that really is the key. Can Nvidia show that this spend is consistent and proving out to be beneficial to the companies that actually are buying these chips and can actually see a return on those chips before they become obsolete because they're used up?
The stock is up by 1.5% of the pre-market later on this afternoon. Following those numbers, don't miss this conversation. Jensen Wong catching up with Bloomberg's Ed Ludlow, 6:30 p.m. Eastern Time. A must-watch conversation. This market has shifted. It's a big change. There was another deal announced yesterday, and you and I have been talking about it through this morning. Anthropic, Microsoft, Nvidia coming out and saying, we're getting together, I'll spend here, you spend there, we'll all make money, fantastic, move on. This market sold Microsoft, sold Nvidia. That's new. That's not what we saw taking place a month or so ago.
Yet fears of circular financing seem to have taken on a life of their own. This idea that they're all sort of hinging on one another's success. We saw that with OpenAI as well as Oracle. And the potential tie-up there has also led to some skepticism about exactly what will transpire. Nonetheless, I think ultimately it comes down to companies, what they're saying about how they're deploying AI, how transformational it is, and what they can give in terms of visibility to a pathway to a future that we still cannot fully imagine. Is it robotics, as the Nokia CEO is talking about? Is it mobility? Is it public safety? Or is it just making sure that your spreadsheet is all dotted and your T's crossed in a more effective way? I mean, but these are sort of the near-term and the long-term issues. Target partnering with OpenAI, also not seeing the reward in the share price. So we just need to see a bigger visibility into what that future looks like.
Then once you get past Nvidia later on this afternoon, tomorrow morning's a big one. Payrolls and Walmart. If you want some visibility on the US consumer right now, develop some thoughts about what the Fed might not do on December 10th. Tomorrow morning, payrolls and Walmart. The payrolls estimate in our survey, 54K.
Yeah, and watch the revisions, too, because we're also probably going to get some revisions to August, and that could be interesting as well in terms of getting a backward look about where the labor market was. Walmart might actually be the greater tell, though, and it might not even be in the results, but in the rhetoric that the new CEO talks about, the outgoing CEO, I should say. He's not going to be the ex-CEO until January, but there's a question here about whether Target is representative of the softness or whether this is Walmart eating Target's lunch, and that's what we'll find out tomorrow.
Equity futures this morning firmer by a third of 1%. Coming up this hour, Alicia Levine of BMY. As stocks look to avoid a 5-day losing streak, Beth Kindig of IO Fund as Wall Street braces for Nvidia's earnings, and Erin McLaughlin of the Conference Board looking ahead to the longer-awaited payrolls report. We begin this hour with stocks eyeing a recovery as tech concerns continue to weigh on equity markets worldwide. Alicia Levine of BMY Wealth writing, we do not anticipate macro downside and so expect the market to rally into year-end. The risk is to the upside from here. Alicia joins us now for more. Alicia, good morning.
Good morning.
Said that last time. What's gone wrong in the last few weeks?
Well, I don't think anything's gone wrong yet. I mean, if you think about it, the S&P is off about 5%. Really, it's the tech stocks that took the hit. But what's interesting, we talked about how high the multiple was in the S&P at 23 times. We're now at 21 times. So the market's done a little bit of work here to take some of the froth out. In the end, we're always looking forward for our client portfolios 12 to 18 months forward. We think this will be a buyable moment. Where it ends, there's going to be, as you said, the next 24 hours gets to all the issues, gets to the earnings, the spending, the depreciation issue on how the P&L is being managed for all these tech companies, which has come up in the last week, as well as what's happening with the labor market, as well as what's happening with the lower end consumer. So you're getting all these issues answered in 24 hours. And I just think that market participants did not want to carry risk into this. It's just too big because you are getting the macro story as well as like the micro of what's going on with this particular trade that has driven the market for the last 18 months.
So Alicia, let's unpack some of that. So we've got a big morning tomorrow, Walmart, and we've got jobs as well. So that should give you some indication, a little bit at least, of what the Fed might do next month. I want to sit on Nvidia. As a company and as a stock, as a company, the earnings should be pretty good because we've heard from their biggest customers, and their biggest customers want to spend more and keep spending more. So I've got that sorted. As a stock, there's an attitude shift that's developed in this market. The things we used to rally on, we don't rally on anymore. What's behind that, and why do you see it changing?
So, look, the big difference here, and you know I can't talk about particular companies, but this is a theoretical, this is, the
entire market itself.
The entire market itself is that the debt financing versus financing from equity or financing from cash flow is the biggest change, and it does introduce a different risk metric. So to me, it does make sense that you're bringing the multiples in a little bit simply because if you're debt financing, that is a different kettle of fish. In the end, we've talked about how the margins are so high, how the cash flow margins are so high, particularly for this sector, that it's able to sustain higher multiples. If that is the case, that in this new world, you're going to compress some multiples here if there's debt financing. So that's the big change here. The tech sector, as a standalone, has already dropped, 2 turns of multiple as well, from 31 times to 29 times. So there's been a lot of work done here. I think it's a reset because I think we're in early innings of this. I also think it's healthy that there are larger questions asked. As we look forward, we expect consumer stimulus coming from the tax code, February, March, and April, as refunds to households, the lower-end households. I think you're going to get a broadening out here, in part because of the questions about how this money is actually getting spent. And in the end, as we know from 25 years ago, there are winners and losers. We've not asked ourselves that question as a market, and it's almost impossible to know. It's impossible to know. So, the companies that are the behemoths today were like, a gleam in an eye of some college kid in a basement, back in the late 90s. So it's hard to know how this is going to get monetized. But the questions are being asked. I think the questions are good questions. You don't want a straight upward move in the market. So this, I think, is healthier.
Although, as an investor, if we're in the early stages, how do you pick the winners for even the mid stages, right? And it sort of goes to the heart of, do you just hunker down with the big tech names that are the big tech names today and generating cash? Or do you bet on the evolution of AI to the rest of the index, the idea of other potential winners in this potential race?
So I think part of what we're seeing here is that evolution from sort of the picks and shovels and the direct beneficiaries to implementation into business strategy. And you're starting to see it in some of the industrials, and you're even starting to see it in the hyperscalers. Like if you just look at some of the revenue per employee for some of the hyperscalers, it's gone remarkably higher since ChatGPT was released. So there's already implementation. The market is going to start picking the winners and losers in the other 493. And that's what we're going to see. That is a healthier place to be. If you're changing your business model, what we know is that the overall margin for the S&P continues to march higher, separate from the top 7 stocks. That means productivity is increasing, and it's likely because there is AI being used across the value chain in many, many companies. Whether, if there's data as part of the company, it's being used.
Well, one thing that people keep saying is that all of this is predicated on enough energy to power it. And increasingly, a lot of the hyperscalers are realizing, oh, no, we don't have that. So we have to come up with a backdoor way off the grid to try to power our sites. I just wonder at what point you can invest in the energy sector, or whether it's hamstrung between policy and politics, between Saudi Arabia and President Trump and the potential agreements on oil.
Right. So look, there are no accidents here, right? I mean, I think that part of the new administration, well, that's not new anymore, but part of the Trump administration's policy was to keep a lid on energy prices, and that is exactly what's happened. We're sitting at $60 on WTI, $64 on Brent. That's exactly what the policy has been, and I think it's no surprise that bring energy down to drive all of the innovation. In the end, it is a competition with our, adversaries out there, and so this is part of the plan. There will be questions asked along the way. The expression is wiser but sadder, sadder but wiser. We are wiser about technological innovation than 25 years ago. We understand there are bumps along the way. What I see is a remarkably resilient corporate sector. The productivity is going across all sectors. We will see it. The margins are higher. And so we can ask questions about debt financing on the top 7 stocks. We got 493. that can also power the market. And I think as a business, we are raising our earnings estimates for next year and for the following year into this. So we believe in the productivity. We see it. We see it in earnings estimates. Yes, some sectors are coming down, like communication services, because of the spending of some of the hyperscalers. But overall, we're raising estimates.
Do you think there's some scarring from .com? That the issues that we saw then have conditioned a certain group of investors?
100%. The way we've had scarring from GFC, right? Like there's scarring there about, is this a bubble? Well, we're up 100%. It's not, a great colleague of mine sent me a bunch of charts on like what previous bubbles look like. We're just like a tiny little speck, right? The appreciation in the market and the particular companies at the heart of this are actually exhibiting a shallow rise in compared to what we know were bubbles in the past. We think we're actually early to mid innings of this, and there's a way to go. The fact that the market appreciated for 6 months in a row, 7% in the third quarter, and we're quivering over a 5% down draw just tells you how great a year it's been. And there was broadening out. And I think, look, we have to get the Fed question also. Like,
sure.
Is the Fed going to cut? I think the chair has been very careful to keep the probabilities at 50-50. Even though we've had hawkish comments, the market's not pricing in anything less than 50-50 on the chances of a cut. And that's done for a reason, because they want optionality to cut.
Let's finish on this. What's a good number tomorrow morning on payrolls? I can tell you the estimate in our survey. It's 54. What's a good number for this month?
I think anything over 50 is fine, right? Because the 3-month rolling average is 29, and that's pretty awful. So anything that pulls, so I think 50 is fine. That will change the probability of whether we get a cut or not also.
Yep.
In December. I think overall you'd rather see a stronger economy and a better labor market. So I think that's important. I think NVIDIA, we'll have to see what the earnings are. But like you said, the hyperscalers are spending. So that's, I think, more knowable than not. And then ultimately, for the largest retailer on earth, half of the American population is a customer. So we'll see what half of America is doing.
And the other half thinks they're Group 1 at the airport. That's the US economy right now. Alicia Levine of BNY Wealth. Alicia, thank you.
Great to
appreciate it. Thank you very much. Looking ahead to payrolls tomorrow, 54K the estimate. Bramo, the high's 105, the low 25.
Yeah, and pick your narrative in terms of how to interpret it. I'm still stuck on what Alicia said about sadder but wiser. And I want to just say that this time is different also than .com.
And wiser but sadder.
And wiser but sadder. Because in the .com bubble, people were excited about the technology. They were excited about the internet. People are less excited about artificial intelligence, and that is different. And there have been surveys showing that people are skeptical, and they're worried they're going to lose their jobs because a lot of these efficiency gains come at the behest of jobs. Is a different tone around the sort of trepidation that people have about the robots.
You can replace people and the word they with I in a lot of those sentences,
but you're
because I feel the same way sometimes.
But actually, surveys have shown that you're not alone. A majority of people feel this way toward artificial intelligence. There is a PR war to be had, if it is a PR war, or at least some kind of way to combat it where people can get a little more excited.
Not alone. Feels like therapy.
Yeah, you're not alone.
It's beautiful.
Join
Thanks, Lisa. Thank you.
Sadder but wiser.
Right, we can hold hands in a
You are
commercial
wiser.
break. All right. Sadder, wiser, sadder. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Shares of TJX are rising 2.8% in the pre-market. The discount retailer boosting its fiscal year outlook after third quarter sales came in above estimates. The results signaling that U.S. shoppers are becoming more frugal as the economy shows signs of stress. Meanwhile, New York Police Commissioner Jessica Tisch is accepting Mayor-elect Zohran Mamdani's offer to stay on the job. The police executive is staying on after several conversations with Mamdani. Mamdani's team praised Tisch and the drop in crime under her leadership. And in sports, Roger Federer was elected to the International Tennis Hall of Fame. This was Federer's first year of eligibility to be nominated, and he was the only candidate with enough support in the player category to join the 2026 class. Federer is the first man to win 20 Grand Slam singles titles. That's your Bloomberg Brief, John.
That was inevitable. Yahara, thank you. Appreciate it. Up next, the Morning Calls Plus, Beth Kindig of IO Fund as Wall Street braces for NVIDIA's latest earnings report. That's next. You're watching Bloomberg TV.
cannot get away from the comparisons to the late 1990s. A lot of the build-out was financed by companies that were incurring debt and had no revenues on the other side. And because you've seen this accelerating debt issuance, there is the worry that that is coming back. And we would say that's actually a good, rational worry.
That comparison just keeps coming up. That was Julian Emanuel of Evercore on the program a little bit earlier on this morning. If you're just tuning in, welcome to the program. Off the back of a 4-day slide on the S&P, we bounced back by just 0.2% on the S&P 500, on the Nasdaq 100 up by 0.3. As we count you down to that cash open, let's get you some morning calls. First up, Guggenheim raising its price target on McDonald's to $3.10, seeing strong same-store sales growth in the US. Elsewhere, Wells Fargo lowering its price target on Home Depot to $400, noting Q4 appears off to a rough start after the company reporting earnings in the last 24 hours. And finally, Jefferies upgrading DoorDash to buy, believing the company's execution and growth algorithm are underappreciated. The stock is up by 2.4%. Let's stay on tech. All eyes on Nvidia earnings today as companies pour billions of dollars into artificial intelligence. Analysts expecting the AI giant to show more than 50% growth in net income and revenue in the third quarter. Bloomberg's Ed Ludlow will be catching up with Jensen Wong later on this evening. Ed, looking forward to that, buddy. What's top of mind for you today?
Yeah, it's a very simple equation whereby if they're going to hit more than 50% revenue growth, net income growth, they
I think we've lost the connection with Ed Ludlow from our own office, in fact, which is bizarre. So we'll try and sort that out in just a few seconds or so. We've talked about the difference between the company and the stock. The company should be okay because the earnings of their biggest customers have been great and their biggest customers are looking to spend more. Down with that. The stock and how it's been treated by this market, that's been a change over the past few weeks.
Well, it was a meteoric rise up, and now there's a bit of a sort of blow off top. And there's a question here about long term, how much companies are going to be willing to potentially continue to buy chips and upgrade at the same pace going forward if the gains are so great. So the forward look in terms of what the sort of runway is for the upgrade cycle for NVIDIA might be really important in terms of some of the rhetoric.
We can't reconnect with Ed, so I'm just going to say it for him. 6:30 Eastern time. Later on this evening, don't miss the conversation with Ed Ludlow and the NVIDIA boss, the CEO, Jensen Wong, coming up on Bloomberg TV later on this evening following those earnings. Beth Kindig is the lead technology analyst of the IO Fund, which since starting in 2020 has outperformed the S&P 500 by more than 100%. Beth writing, NVIDIA has no debt or cash flow issues in funding its AI roadmap. Unlike big tech, with large capex bills, the market hasn't fully factored this in yet. Beth joins us now for more. Beth, welcome to the program. We've got the stock and we've got the company. I want to focus on the company. This should be quite straightforward, shouldn't it, after we've already heard from their biggest customers, and they're looking to spend and keep on spending.
That's a great point. Thanks again for having me. Big tech capex, you cannot underestimate the importance of that number. We're seeing 19% quarter over quarter growth. Now, this is at scale. These are large numbers to be growing nearly 20% quarter over quarter. Our largest growth this year in big tech capex. It's communicating and foreshadowing what we will see from NVIDIA this evening.
Beth, how this market treats this stock has shifted. How this market treats this story has changed. I think yesterday's a really interesting example that Microsoft, Anthropic, NVIDIA come out and announce a deal, an agreement to invest in each other and all make money and everything's going to be fine. And we've seen those kind of agreements before and the stocks would typically rally. Beth, they didn't yesterday. Have you noted a change in the reaction function of this market to incoming information? And why do you think that's going to change anytime soon?
The market is emotional. It's sentiment driven. However, for years now, I have encouraged investors to look at NVIDIA according to its GPU generations. You had Ampere, you had Hopper with our big moment in a couple years back. We're moving into the Blackwell-Rubin cycle. Jensen Wong gave an incredible statement when he said there would be 500 billion cumulative revenue. Now, what my company has modeled is that means we will end next year in the 300 billion to 320 billion data center mark. Now, stay with me. We have been forced to update our models. I originally had a 10 trillion market cap by 2030. I am now raising that to a 20 trillion market cap by 2030. Therefore, I am not concerned as to how the market feels from day to day. the long-term roadmap is laid out, the product roadmap, and the vision as to how this data center revenue will continue to grow could not be more perfectly handed to investors than what we've seen over the last month.
Beth, if the revenue is so sustainable, why does NVIDIA have to give money to so many of its clients to buy its chips?
That's a great question. And I would look at it less as this big .com worry, and I would look at it more as an exercise of R&D. We have a common denominator, which happens to be NVIDIA's GPUs. We want NVIDIA to work alongside the R&D labs and big tech and make sure that America remains competitive. I would not look at this as some big concern that everyone's depending on each other. I would look at it as a race to try to be in the lead. And that piece is something that all AI investors should want. And I believe it will continue on an upward investable trajectory, which is very different than those who have .com concerns.
Well, it does raise a question, though, and it's not just the U.S. companies. We were just speaking with Nokia earlier, and they have also a partnership with NVIDIA. I just wonder, at what point do all these companies become so intertwined that if there is a weak link, it will have ripple effects that are much more substantial than many people appreciate?
What I would argue back is that AI is very early. So investors have this incredible opportunity to get in early. Usually that happens at the venture capital stage. So you see, all of these startups trying to bring a technology to the market. Instead, because AI is so incredibly expensive at the onset, public investors have an opportunity to get in early. What we're seeing, in my opinion, is very normal for early stage technology. And my company has done quite well by positioning with the picks and shovels trade. And that piece has so far paid off in spades. I expect it to continue to pay off. And look, come on, big tech has a lot of cash. It's not going to run out of cash. The company's spending all of this CapEx. They're pretty cash efficient companies. I don't have a huge concern as to big tech running out of cash anytime soon.
Beth, appreciate the update from you. Beth Kindig there of the IO Fund. Big tech, super strong balance sheets. They're the one issuing the debt. Totally with her on that. We'd all agree. We've been asking a question, though. Is this story built on that or built on OpenAI, where things are a little bit more flaky compared relative to the strength of those balance sheets elsewhere?
And is NVIDIA leveraged the idea of an eruption in technological prowess and advancement that it needs to also fund because nobody else can? How much are they going to be sort of instrumental in the money and the purse behind any kind of advancement that people are hoping to achieve?
NVIDIA higher this morning in the pre-market by 1.7%. Coming up, Erin McLaughlin at the conference board as we look ahead to a long-awaited jobs report tomorrow morning. From New York City, you're watching Bloomberg TV. .4% correction on the S&P 500. Can we call it a 4% correction?
It feels like it.
S&P?
It feels like a 4% depression compared to the way some people talk about it.
So spoiled up and to the right. Since the lows of April, 4% move, and it feels pretty depressing.
Yeah, well,
at the index level.
It was more than that, though, for some names, and I think that's a reason why people who have invested heavily in tech are taking it on the chin. And you're seeing the Nasdaq underperform the S&P 500 in the equal weight, almost by twice as much over the past, frankly, since the start of November.
NVIDIA in the pre-market this morning doing a little bit better, but over the past few weeks we've had a correction of more than 10% on that name, down about 12%. Going into that earnings report later on this afternoon. Equity's doing better so far this morning, though. As we count you to the opening bell, about 60 minutes away. Let's get you some morning movers with Danny Berger. Danny has more. Hey, Danny.
Hey, John. Some of the retailer earnings we got this morning. Target was among them, down 3% in the pre-market trade, reporting results that disappointed, having to trim some of the high end of its expectations. The fear is that this turnaround that they've been trying to engineer is taking longer than expected. So not only are the results not showing up, but they're having to invest more money for that turnaround too. $5 billion is their capital expenditure target, saying that they are going to do things like build more stores, invest in the stores that already exist, invest in merchandise. So again, those shares moving lower. Some of the other retailers we heard from this morning include TJX. maybe a bad sign that this company is doing well. It sells a lot of discounted clothes, and they beat expectations. They also raised what they see as comparable sales for the year, so those shares trading up 3%. Finally, ending with a little bit of deal news. Adobe will be purchasing the AI and marketing company SEMrush for about $1.9 billion. The price tag on that will put it at $12 a share, so you can see the premium starting to lift shares of SEMrush by about just under 75%. And this is Adobe's first deal since the failed attempted takeover of Figma, so that moving the shares higher this morning, John.
Danny, appreciate it. Thanks for the update. TJX, so far this year, higher by more than 20%. It's one of those names, it's like Walmart, right? If it's doing badly, it must be really, really bad. And if it's doing well, it must be bad.
Yeah, exactly.
And that's the game we'll play tomorrow.
That's the story that we're playing right now, because TJX is viewed as doing well because people are looking for discounted clothes. How much are people trading down? And that's going to be a big question with Walmart, I'm sure, on the call tomorrow.
Walmart tomorrow and the jobs report as well. Later on this afternoon, we get some Fed minutes. A bit of data just moments ago. Let's get you an update and cross over to Bloomberg's Mike McKee for more. Morning, Mike.
Good morning, John. It feels very weird to be back in the chair talking about data that has crossed, but we do have the first data since the shutdown ended, and it is international trade for September. The trade deficit falls to $59.6 billion. The estimate was for 60.8, and we were at 78.3 in July. Now, this is old data in the yes, but category. It does matter because it's basically the final piece of data that analysts need to put together the third quarter GDP report, which is going to be released in next week. So good news for the overall U.S. economy, and kind of one headline out of this. Imports from Canada in September were at their lowest since May of 2021, and that, of course, was during COVID. We're not getting along with Canada very well on a trade basis these days. Now, as I mentioned, GDP comes next week. Tomorrow we get the September jobs report. Not sure how much that's going to matter, but we will also get the latest numbers on jobless claims from last week. The Department of Labor is not going to publish the missing numbers between the start of the shutdown and the number that comes out tomorrow, but they will put the data online tomorrow afternoon. So if you want to go back and look at it yourself, you can. But we'll get the latest numbers and see where we are there. Real earnings Friday, not a big deal. The September PPI comes out next Tuesday, and then we get that GDP number for the third quarter, and they're going to go straight to the second version because they've already skipped past the first. That comes out Wednesday, along with income and spending for October. That's going to be an important number for a lot of people trying to calculate where we are. Then we get November income and spending on December 19th. We still do not know the fate of October's jobs, CPI, and PPI. The White House says they're not coming out, but we haven't heard that from the BLS. Jobs, CPI, and PPI for November. We don't know when those will come out, and we're still waiting on the status of October and November retail sales. But we get started this morning with trade.
Mike, can I ask you about claims? You mentioned jobless claims. Has that been a reliable anchor to establish a view on the health of the labour market, or has it been a misleading one? If you focused on that, have you missed what's happened elsewhere?
Well, from what we have seen, the data that we've been able to download and adjust, we look like the theory that everybody's had of a low hire economy. So if we get something in the 220 range tomorrow, that would just confirm it, and it kind of gives the Fed the idea that they have a good idea of where the economy is, at least in the labor market.
Mike McKee, thank you, sir. Mike down in Washington following that trade data. More data still to come. This could be very noisy over the next few months. Erin McLaughlin at the conference board writing the shutdown's ripple effects could shave roughly 0.5 percentage points off of GDP growth in the quarter, but most of it will likely be recovered in the beginning of 2026. Erin joins us now for more. Erin, welcome to the show. This Federal Reserve starved of economic data. They'll finally get some. How noisy is it going to be?
Well, I'm not really sure it will change much since it's so backward looking. And I think similar to your other guest that you had this morning, a lot of it will be business as usual. As Mike just said, low hire, low fire. I do think that sort of the era of labor hoarding, which we've seen over the last couple of years, is probably coming to a close.
How much have we already gleaned from consumer confidence and from a sense that people are not feeling good about their prospects in the labor market? Can you connect that to what's actually going on the ground, or have you seen a divergence between sentiment and the reality to a degree that makes it unreadable?
Well, the sentiment from our consumer confidence index has essentially been very sideways moving. So, there's a little bits of change here and there. But when you dig a little bit deeper, what's really interesting is that consumers feel relatively optimistic. I mean, it's still pretty low, compared to last year or the year before. However, they're pessimistic about their expectation for 6 months forward. And so I think that that's really, really telling. The other thing that we asked in our most recent survey was about holiday spending, which obviously will be really key for a lot of big companies. We're still in a very consumer-driven economy. And our surveyors said that they expect to spend 4% less this holiday season than they did last year. And I also think that they will experience higher prices. We saw inventories, when we look at trade data, really up in the first quarter of this year, but they were very flat, or lower than other years. And so sort of pulling that inventory earlier to save on tariffs and being able to pass that down during the holiday shopping season might not happen. And so the combination of increased prices and the expectation of increased prices may result in just lower spending.
Erin, if people started their day with a cheaper cup of coffee and a cheaper banana, do you think that they would spend more elsewhere?
Yes.
Okay, so coffee is that affecting things?
Coffee is up 20 to 40%, depending on the kind of coffee you're purchasing. And, it's really, I've been focused very much on trade at the conference board this year. And it's very interesting to look at these policies and think about how overly broad they were when these tariffs were enacted, because we only grow coffee in Hawaii. Right? We do not grow bananas. And so to have to go back and revisit some of these policies is really interesting. And to pick up on what we were just talking about with Mike McKee on Canada, when I dove really deep into trade data for this year, after China, where trade is down about 19%, the only other major trading partner that we're down both imports and exports this year is Canada, where we're down about 3 or 4%. And so I think there's still that continued uncertainty. The USMCA trade agreement is not up for that renegotiation until next summer. Our agreement with China is, basically our truce is only for 1 year. So for so many importers, manufacturers, and others, we still have continued uncertainty.
Congressman French Hill made a similar argument, Bramo, earlier on this week. The Republican from Arkansas, not a fan of broad-based tariffs, sympathetic with the national security objectives of doing certain things on certain countries, but doing broad-based things like this and hitting things like coffee and then needing to backtrack kind of undermines the decision to begin with and the objective behind it.
Which raises this issue going forward. Are there other tariffs that are going to be walked back? What does this mean for the Supreme Court decision? Will that be used as a smokescreen to walk back serious parts of some of this initiative? And what does that mean for the deficit? I know I sound like such a negative Nelly, but you have to wonder if people are counting the idea that we're going to get revenue from these tariffs. Is that revenue not really countable, given the fact that potentially this will be rolled back?
Erin, we're running deficits of 6 to 7% of GDP in this country. And this is something that this administration has inherited. I understand we can talk about the trade story, but the mood of the consumer was pretty dire before President Trump walked into the White House, and that has continued. Erin, what's behind that? And is there a spread opening up between how the consumer feels about this economy and how businesses feel about this economy, the companies that you track?
Yes, that's a great question. So we also have our CEO quarterly survey that we do. And CEOs were so excited at the beginning of the year, essentially because they were looking forward to lower regulation and to sort of an increasingly friendly business environment. The tariffs have upended some of that, and the continued uncertainty has upended some of that. For consumers, I think a lot of their malaise is really related to the really big changes that we see that we can't predict or necessarily get excited about, and sort of thinking about AI, for example, and really understanding what jobs may be displaced, or in really understanding how they may benefit or their families may benefit, that uncertainty has just increased. Things like the federal deficit, most consumers do not think about that when it comes to their day-to-day or month-to-month spending.
Erin McLaughlin at the conference board. Erin, thank you. Fantastic to catch up. As always, it's good to see you. This is an interesting situation for corporate America to feel good about the future, to forecast better earnings. And yet we look at the labour market, employment growth is so bad, and the way the consumer feels about things is so dire. How are we going to close that spread? Because I tell you, for society to function normally, for politicians to be comfortable in the seats they've got, that gap, that spread, needs to close.
And this is the reason why the Fed is talking about cutting rates. And I understand that they're not a political body, although some people might disagree. But there is this feeling that that sentiment in the rank and file of people who don't feel the benefits that companies are talking about are going to be more important or sort of given the priority on the Federal Reserve. You're right to point this out, because a lot of what companies are saying, the optimism comes in their creativity and innovation of becoming more efficient, of doing more with less and reaping more profits, even if they don't necessarily have the best backdrop. And this is really a conundrum that's going to be a political issue for a long time.
Futures this morning positive by about 0.2%. A big 24 hours coming up. Later on this afternoon, earnings from Nvidia. Tomorrow, we'll get numbers from Walmart and a much-delayed payrolls report. September payrolls dropping on November 20th. What has been going on?
Yeah, and is it going to be useful at that point? And that's the reason why I keep saying maybe revisions to August could be really important, given the fact that you get more of a trajectory heading into October, which we're not really going to get, because it'll be really messy and we're not going to get an unemployment rate.
It's all good news. Other than that, let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. China made its biggest daily purchase of U.S. soybeans in 2 years, signaling support for last month's trade truce. The USDA says Beijing bought 792,000 tons on Tuesday, taking total purchases since October above 1 million tons. President Trump says he still wants China to speed up its buying, even as U.S. soybeans trade at a premium to Brazil's. Meanwhile, the Department of Energy is backing Constellation Energy's restart of 3 Mile Island. The Trump administration has lent the company $1 billion to restart the Pennsylvania nuclear plant. Constellation unveiled plans last year to start the plant through a power purchase agreement with Microsoft to support the company's data centers. And shares of Target are lower by 3.5% in the pre-market after it lowered its profit forecast for the year as a retailer deals with markdowns and soft demand in key areas. The incoming CEO said Target experienced choppiness across its business during the quarter and that it's been difficult to pinpoint specific drivers for the softness. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Zach Griffiths of CreditSights. You're watching Bloomberg TV.
The Federal Reserve, just like markets and economists, are going to have to think a little bit further out into what Q1 and Q2 are going to look like. And probably that tells us that employment will become slightly more problematic, not dramatically, and inflation will continue to rise. It's a continuation of that stagflation-light type of environment.
Francis Donald of RBC, Stag Light sounds like a really bad drink, doesn't it? I remember the first time I heard that, Stag Light. But ultimately, that's what she's looking for in 26.
It's a stag dance where you don't get a dance, essentially, right? I mean, it's sort of, yeah, but this is kind of where we're at. But we don't get the CPI data, so we can't even know how stag it is, just light.
Stag light, a terrible night out. Equity futures on the S&P, positive by 0.25% right now. We're up by a third on the Nasdaq. On the Russell, we're up by 0.4. In the bond market, Treasury shaping up as follows into tomorrow. Yields down at the front end of the curve, 356. It has been a snooze at the front end of the curve. Anywhere between 350 and 360. Why? Because this Fed is just totally gridlocked. What is going to break the gridlock? If you can work that out, you can work out which way this one's going to cut, which way this is going to break in a month to come.
Yeah, and potentially what the rhetoric is going to be going forward, because it seems like the last time was clearly a hawkish cut. There was a signal that Jay Powell put to the whole market, which is this is a split committee and December is not a certainty. We've gotten that pricing in. How much can they give guidance going forward, given the fact that there's going to be a real composition shift to the Federal Reserve?
And a new leader at the top of that Federal Reserve, a politically correct leader at the top of that Federal Reserve.
What does that mean?
To me, that's Governor Waller. We talked about this.
Right, but
to me, that's Governor Waller.
But you are not President Trump, so
I know, so I can't get in his mind.
I mean, you could try. What do you think it is?
That would lead me to believe it's Hassett.
Yeah, that's
right?
kind
Based
of,
on that.
And that's
If
what
it's
the
not
market
Besser,
believes. Well, that's
right?
what the market's pricing in right now. That's the greatest chance would be Kevin Hassett as the new Fed chair.
He's the favorite. Politically correct? I don't know.
To who?
That's up to the president. Equity futures on the S&P 500 doing okay. Yields down by about a basis point. Big week coming up. Big few days coming up. This is the trading diary. This is what things look like. So later on this afternoon at 12 p.m. Eastern Time, President Donald Trump will be speaking at the U.S.-Saudi Investment Forum in Washington. At 2 p.m. Eastern Time, the Fed meeting minutes. Then after the closing bell, the big one, NVIDIA earnings, followed by an exclusive conversation with the CEO, Jensen Huang, at 6:30 Eastern Time. On Thursday, so tomorrow morning, a delayed payrolls report, jobless claims, and Walmart earnings. And for good measure, into the weekend, UMich consumer sentiment. All of this, some new data for the Federal Reserve. Zachary Griffiths, the head of US IG and macro strategy at CreditSights, is still expecting a cut in December. We expect continued labour market weakness to produce demand-driven disinflation, leading to the need for more aggressive easing. Zach joins us now for more. Zach, welcome back. Always good to catch up. What does aggressive easing mean? How many cuts is that?
Thanks, John. So right now we have a cut in December, and we're looking for 3 more in 2026. But what I think is more interesting is our expectation for the market to price in a terminal rate that's lower than what we currently see in SOFR futures. So we think the Fed could ultimately cut to 2.5%, but it may be a bumpy path in terms of what the indicators tell us about the balance of labor market and inflation. To us, we are expecting more labor market weakness to lead inflation lower and to allow the Fed to deliver more rate cuts and what we think is going to be a much more challenged consumer environment in 2026. I think we've gotten very used to a consumer that's been very resilient and surprised to the upside. We think that comes to an end in 2026.
Zach, why are you seeing this in particular? Because ultimately the corporate earnings, while they haven't always beat expectations, they've been okay. And they point to, yes, some potential softening, but not exactly softness. What do you think we're getting wrong about just how weak the consumer is?
I think the big thing, Lisa, is going to come down to the labor market. If we actually see job losses, and we have seen more announcements of layoffs, that's going to be the key to the scenario that drives actual consumer weakness. I think throughout all of this, we've heard excess savings have fallen. We've heard consumers exhibiting value-oriented behavior, but we really haven't seen the downshift yet, and it's because we haven't seen material job losses. I think we can see net monthly job losses at various points over the next year or two, and I think that's going to drive more weakness in the consumer. I think as long as they have a job and are continuing to earn, you can keep spending, but once you start to see cracks there, it kind of drives the entire economy toward a slowing to below potential growth next year.
How frustrating is it, Zach, to have this call to go into duration at the expectation of what you say? Potentially we could see that, and the long end could still sell off when we see yields go higher because of Japan. I mean, how much is this a story that you can really just specifically focus on the U.S. economy as you try to get it right?
You're right, Lisa. It's certainly a global market. And when we think about going forward, what's going to be more important, I think that the expectation that the Fed can deliver more in terms of rate cuts than the market is currently priced for is a big one. And of course, the Fed also, we think, could be adding to its balance sheet as soon as early 2026. So I think those are two big factors. They can't completely offset what we're seeing globally, which I think is growing fiscal concerns, the potential for the Bank of Japan to be hiking rates. So it's not a one-way trade, and I think that's really what the Fed has been trying to communicate. The market had gotten very comfortable with kind of one direct path toward lower rates on the magnitude of 100 basis points getting to around 3%. They've called that into question. On the inflation side, we ultimately think that the labor market's going to deteriorate further and cause their focus to shift there while also causing disinflation. So I think you have the monetary policy side in the U.S. as the key driver. You have the curve steepening and yields moving lower across the curve.
Zach, you said some things there and I heard QE. Did you mean to say QE?
Not QE necessarily, John, but the balance sheet growing to accommodate growth in the liability side of the balance sheet. So we're not calling for quantitative easing. We're not calling for a recession, but we are calling for a more notable downshift in economic growth than what we think the market is priced for and what the consensus is. And so to us, that means moving into long duration for total return focused investors. For excess return focused investors, we think it could be a more challenging environment. We prefer moving up in quality and shorter in duration for those focused on spread, as we think we could see decompression across the ratings curve and a steepening of the spread curve.
Zach, just stay on credit just for a beat. A question I wouldn't typically ask you. How important are the earnings from Nvidia later on this afternoon to your universe, to investment grade corporate credit in America?
That's a great question, John. And I think it's huge for sentiment broadly when you think about risk sentiment for equities and even credit, perhaps to a lesser extent. When I think about what is going to drive the credit market from a broadly tech perspective going forward, right now, tech makes up around 6-7% of the investment grade index. Our analysts are calling for issuance next year, tech to compose 20% of that. And so I think really when we think about balancing technicals and fundamentals, we think the tech side of the ledger becomes more of a technical and fundamental headwind, as Oracle, we expect, may need to come with as much as $85 billion in new debt over the next 2 to 3 years. So to me, I think earnings are important, but looking at how much of this future CapEx will be debt funded is kind of the key and a driver of our more cautious view toward fundamentals in IG credit in 2026.
Zach, thank you, sir. Well framed. Zachary Griffiths there of CreditSights. This market's changing. The way these companies operate is changing. The way credit trades is changing. What compiles these indexes changing. There's a lot to track here. It's all changing.
Yeah, and the terms are changing too, because it's not quantitative easing anymore. It's balance sheet expansion. It's not shadow banking. It's now private investing. So we have new terms to go along with a very different market.
Did you hear QE?
I mean, no, I heard balance sheet expansion to accommodate different liabilities, which is
it's a different flavor.
It's a different, which is not quantitative easing, John.
Coming up tomorrow, Brian Levitt of Invesco, Angela Zeno of CFRA, Seema Shah of Principal Asset Management, Sarah Malik of Levine, and a whole lot more. Nvidia earnings after the close. Don't miss Ed's interview with Jensen Wang of Nvidia at 6:30 p.m. Eastern Time from New York City. From us, good morning to you all. Have a wonderful day. We'll see you tomorrow morning. This was Bloomberg Surveillance.